Thank you. And hello, and welcome back to the CFA Institute Research Challenge Finals for the Americas region. My name is Peter Watkins, and I'm the Global Senior Director for University Programs at CFA Institute, based in our London office. So, things are really hotting up. The 6 teams competing today have already achieved significant success, winning their local competition, competing against neighbouring universities in their local region. You then went on to succeed in the second round of the competition based on the presentation of your excellent research analysis reports. Then earlier this week, you triumphed once again in the live regional semi-finals, offering superb presentations and surviving a lengthy question and answer session with panels of expert judges. We really are seeing the brightest and best finance students from right across the Americas. Congratulations to you all. I'd like to thank our sponsors, London Stock Exchange Group, for providing access to their data service platform and an authentic learning experience for all of the students competing. I'd also like to thank our volunteer panels of expert judges who have given their time and considerable commitment to support the development of so many future investment professionals from right across this region. Our judges are firm, focused, and fair, and we're very grateful to them all. Now to the details. Everyone is currently in the main session room. Throughout the event, we will move participants as appropriate to virtual breakout rooms, where the presentations and question and answer periods for each team will take place. All teams, beside the first presenting teams, will be moved to their own individual rooms when the presentations start. Teams should remain connected and present in these rooms until they're moved to the presentation room. After your team has presented, you may disconnect and rejoin for the advancement announcement at the end. Only the timekeeper, teams, and judges should have sound and video enabled at any time. All other attendees should remain muted with your video off. A 1-minute warning will be provided for the presentations, but not for the Q&A period. As a reminder, the Q&A period for the regional final round will be up to 15 minutes. For the best viewing experience, we suggest hiding non-video feeds. There are many viewing options, so we suggest taking some time to find a view that looks best for you. So, the teams competing today are Babson College, representing CFA Society Boston. Fundacao Getulio Vargas, FGV, Sao Paulo, representing CFA Society Brazil. University of Albany, SUNY, representing CFA Society of New York. University of Denver, representing CFA Society Colorado. University of Minnesota, Duluth, representing CFA Society Minnesota. And the University of Waterloo, representing CFA Society Ottawa and CFA Society Toronto. The judges today will be Mark Temnikov, Serkan Uza, and Olivier Muller. I'm thinking I may have got the judges' names wrong there. Apologies. I will correct that. At this time, we will start moving judges, guests, and then the first team into the presentation room. This may take a few minutes. We wish you all the very best of luck. Thank you.
All right, looks good.
Okay, please stay muted unless you are speaking. I will start time as soon as a member of your team speaks their first word. You will receive a 1-minute warning and time will end precisely at 10 minutes. Please feel free to begin.
Hello, everyone. My name is Andrea, and I'm accompanied by my colleagues, Matt, Nick, and Emilio, and we're all very excited to present this short opportunity to you. We're currently pitching Toast Inc. as a sell with a target price of $13.58, representing a 45.5% downside over the close of Friday, March 29th. Now, Toast is a fintech company, more specifically a POS or point of sale system with restaurant management software. This means that Toast processes and manages client payments, inventory, online orders, among others. Their growth is concentrated in the Northeast region and is driven by the total location count or penetration rate, a percentage taken from each transaction, also known as the take rate, and their average revenue per unit or ARPU. Now, let's take a look at our investment thesis.
First, we believe Toast's serviceable addressable market is overstated, limiting potential for new location adds. Consensus expects 99,000 location adds by 2028, implying Toast's restaurant penetration will double from 12% to 24%. However, we believe the next 12% of incremental penetration will be substantially more difficult than the last. Historically, Toast has targeted wealthy, tech-savvy areas, as demonstrated by the correlation between POS systems and GDP. However, the rapid uptake in the Northeast region cannot be extrapolated to traditional single-location restaurants, which comprise 70% of all U.S. restaurants. Restaurants in regions with low penetration, such as the West and Midwest, are smaller, have less resources, and are more price-sensitive. Toast's platform will be too costly to onboard these restaurants, or Toast will have to sacrifice ARPU to meet penetration expectations. Now, to understand the true picture of Toast's addressable market, we called over 1,000 restaurants and spoke to 200 restaurant managers about their POS system and any intentions of switching. And across our calls, we learned 75% already have a POS, 15% don't have one and don't plan to get one, and about 10% are open to switching. Now, considering the percent open to switching across all 860,000 US restaurants, we learned Toast's actual potential new locations is just 91,000 restaurants, which is several orders of magnitude lower than management's estimate of all 860,000 US restaurants.
Additionally, we believe that growing average revenue per unit, or ARPU, within Toast's current restaurant base will become increasingly difficult as competition intensifies. Given Toast's margin profile, SaaS ARPU must increase to drive operating leverage. However, while Toast has continued to add locations steadily over the last several quarters, both SaaS ARPU and gross payment volume per location growth have been trending downwards, insinuating that the company is sacrificing ARPU growth to garner location wins over competitors. As a result, we conclude that the new locations that Toast has added comprise restaurants with less revenue. Additionally, they are more price-sensitive and less likely to purchase elective software modules. As 2024 progresses, we see two catalysts increase in competition. We expect Square's updated sales team to outperform in metropolitan regions, and Clover's upcoming kitchen display system launch will limit Toast's win rate. While tech-savvy restaurants have continuously spent more money on Toast, we believe that future spending will not grow at historical rates as competition increases and the company targets restaurants with lower transaction volumes. Restaurants already have narrow profit margins of 5.7% on average in the US, with Toast's average restaurant on platform spending about 3% of their revenue on Toast alone. From here, we see limited room for increased expenditure. Our expectation is supported by our primary research, as the #1 deterrent of upgrading systems cited by restaurant owners and managers was cost. As a result, we forecast lower subscription services revenue than the street expects.
Moreover, we consider that free cash flow generation is not only limited at the top line by revenue growth, but margin expansion will also lag expectations. Now, on a GAAP basis, Toast had an EBIT loss of $2,903 per location in 2023. To achieve profitability, Toast has two main levers to pull. They could either increase their gross payment volume per location by 9%, or they could increase their overall SaaS revenue per location by 57%. Now, GPV per location is unlikely to extend that far because Toast has turned towards lower GPV restaurants to expand that location count. On the other end, and as priorly stated, significant SaaS revenue increases are also unlikely since Toast's customer base has become less apt to purchase elective software modules. Now, Toast pressured revenue growth makes this margin expansion imperative. However, cost cutting across S&M, R&D, and G&A does not align with Toast's expansion strategy. This strategy requires heavy investments in S&M and R&D to maintain these competitive products while marketing them effectively to drive growth. Toast has proven to be a laggard in correcting this expensive behavior. For example, headcount, which is a strong investment proxy, remained heightened until their past earnings, where they announced 500 layoffs for the future. With these points in mind, our EBIT estimates are projected to grow below consensus for the next 12 months.
As seen, penetration, ARPU, and margins are vital drivers for business performance. However, a closer look at the company reveals that consensus is incorrectly forecasting these drivers. Firstly, we project increased competition and expansion to low GDP areas to hinder their ARPU growth. Next, the market size Toast has stated has led to unrealistic location growth assumptions. Our research indicates that the true SAM of Toast is drastically lower, resulting in fewer projected new ads per year.
Looking at cash flow, the street utilizes cash EBIT. Cash EBIT's most significant add back is stock-based compensation. Although stock-based compensation is not a cash outflow on its own, the resulting dilution to Toast equity means share buybacks will be needed in the future, or shareholders will continue to be diluted. This means that stock-based compensation will become a cash outflow as cash is used to make share repurchases. Now that we have demonstrated the continued deterioration of company fundamentals, let's move on to our valuation. Our valuation results in a blended price target of $13.58, a 45.5% downside to the share price as of March 29th. The blended price target is composed 50% of a discounted cash flow analysis, 25% a comparable company analysis, and 25% a sum of the parts analysis. The discounted cash flow analysis was driven by a WACC of 11.6% and utilizes a 2024 EV to gross profit exit multiple of 4.6x for the terminal value. This exit multiple is derived from the median value of peer companies presented in the comparable company analysis. The key metrics that drove our DCF were slower penetration, limited margin improvement, and lower ARPU growth. Our comparable company analysis was driven by a 2024 EV to gross profit benchmark to the 70th percentile of the peer set. Our sum of the parts valuation was driven by a median 2024 EV to gross profit metric and is a segmented peer analysis weighted by Toast segment revenue. Additionally, we conducted a Monte Carlo analysis to test our assumptions, adjusting the revenue and cost of goods sold by our bear and bull cases. This gave us confidence in our analysis as the mean price was $14.22, representing a downside of 43% as of March 29th.
Now, let's look at the impact of the company's operations on sustainability and social responsibility. Toast tends to underperform on ESG. On a relative basis, Toast performs below the median. Our team conducted an analysis using MSCI scoring framework where we reviewed ESG reports of Toast and its peers and looked at the adjustments that MSCI made to rank these companies on a scale of 1 to 10, with 10 being the best. Our team projected Toast ESG score to decrease from 4.43 to 4.19 over 2023. However, MSCI increased this score to 4.8, with our main discrepancy being our governance score. Toast social score increased primarily with the implementation of a DEI scorecard, tying the bonus plan for all senior leaders to improving this firm-wide diversity. Our team believes these improvements are outweighed by a decrease in their governance score. This is due to Toast's controversial implementation of a 99-cent online processing fee on all orders above $10, which went against the company's keep costs low for customers commitment and was received with heavy backlash by clients, besides sustaining our thesis points on limited opportunities for price increases. Following this, in September of last year, CEO Chris Comparato announced his departure, with co-founder Amon Oren taking over. MSCI did not consider this in calculating the business ethics, but we believe it should be included in analyzing management behavior. With that said, we acknowledge the potential for score improvement in 2024 due to DEI efforts, while we remain cautious of the impact of business ethics going forward.
Finally, we'll highlight the key risks to a recommendation. We foresee 3 main specific risks. First, while Toast's flywheel effect has led to penetration growth from restaurant referrals, we see this as an inherently risky business model as metropolitan markets will eventually get saturated. According to a former sales manager at Toast, it's unlikely that the company surpasses 20% share of the US market. Additionally, while international and upmarket expansion yield new growth opportunities, Toast lags peers in establishing itself outside of the US, and enterprise restaurants require expensive R&D solutions, limiting upmarket opportunities. Accounting for these risks, our upside scenario for Toast share price is roughly $27.
As we've seen, investing in Toast is not all butter and jam. Since the company's financials, valuation, and top-line fundamentals have left us questioning every last crumb, we reiterate our sell recommendation on the stock. Thank you, and we will now take any questions.
Thank you. Judges, at this time, please turn on your video. Please stay muted unless you are speaking. I will start time as soon as a judge speaks their first word. The Q&A period will be at least 10 minutes. If it is still going after 10 minutes, we will continue for up to 15 minutes total. If any time after 10 minutes, the judges have no remaining questions, we will end the Q&A period before 15 minutes. Please feel free to begin.
I'll go ahead and start. Thanks for doing that today. Question on the, I think you showed a slide on revenue. There was one that you showed revenue. It was sort of an attribution of revenue and expenses and free cash flow. It's kind of like a stacked line chart.
Dollar contribution?
Mm, just maybe take me to a slide if you could on just one that shows revenue, like a historical revenue. Okay. So here we have a company where they do have revenue growth here, right? So total revenue, let's say early 2022 of 27.31, and now they're up to 8. So, and you have a sell rating on the stock. There was another slide. I think you had expenses, and it was showing sort of expenses coming down. So how do you think about a company that has increasing revenue and increasing gross profit and increasing EBIT? Why would you sell a company that's increasing in all those areas?
Absolutely. I can start out with that, talking about the revenue, and then we can touch on the margins. So if you could go to the slide on our primary research. Sure. So we acknowledge that they've been able to grow quickly, and they do have a good product that they've been able to onboard some restaurants with. However, we think that as a result of their previous growth, they've been assigned a lofty multiple, and their valuation is just a bit too high. So we're really looking at the opportunity going forward and how that's going to impact their revenue growth. So what we did with this primary research was call randomly sampled restaurants across the United States to determine what percent of restaurants are open to adopting a new POS system. We learned that the majority ultimately have a POS and don't want to switch, or are just traditional and don't want one at all, with just 10% being open to switching. Now, when you apply that to all the restaurants in the US, that's about 90,000 restaurants. Now, what's being implied by their 2.3x EV to sales multiple is that in the next few years, they're going to reach 200,000 restaurants penetrated in the US. Right now, they're at about 100,000, right? So that's a gain of 100,000 restaurants. But we saw from our primary research, there's only about 90,000 willing to switch. So what's baked into the stock price is not only that they'll capture 100% of the market of the restaurants who are open to switching, but that they'll also uproot POS systems that are already in existing restaurants, which we just find extremely unlikely at this point, which is why we think they'll continue to grow revenue, just not at such an accelerated pace, making their EV to sales multiple a bit overstretched at this point.
Yeah. Additionally, I could add on to the COGS and
Real quick, let me ask a quick follow-up and then I'll step aside.
Yeah.
On their revenue, is their revenue from a fee that's based on the amount of revenue that the restaurant is doing, or is it a fixed for the restaurant? You know, if does it matter what their sales are to Toast's revenue?
Yes, it's a function of both based on their take rate as well as the upsells of the software products within the restaurant.
Okay. So the main sell thesis here is it sounds like pretty considerably based on valuation.
Yes, we do believe it's a good product. It's niche down to the restaurant industry. However, it's just a good company at a bad price.
Okay. Thanks. Good job, guys.
Slide where you have the relative valuation analysis. And my question is related to your peer set. How do you go about selecting the peer set, the peer group for this company? And why do you think this peer set that you selected reflects the same risk factors as Toast?
Yeah, I can speak on that a little. So when we were doing our peer selection, we wanted to look at a representative sample of POS companies, specifically with those operating within the restaurant space. And all of these restaurant POS systems we see here have significant amount of their customers within the restaurant space. However, we also wanted to acknowledge that there are mature POS companies within the space, and these would be companies such as NCR, which have operated within the POS system for restaurants for a long time. And there's also disruptors such as Shift4 and Square. And so by taking both of these, we could look at both the more Toast-like companies such as Square, which are growing at fast rates and applying to a lot of new restaurants on a cloud-based technology, and also look at the representative mature companies that have operated in this space for a long time. And we think Toast will ultimately represent a mature company as their growth moves on. And so we wanted to see a more representative multiple for a company within the broader restaurant space.
Yeah, and if I may follow a question to that, I see you selected EV to gross profit as your metric. Why is that, and how do you account for the differences that might arise from having gross profit in terms of more standard, more GAAP metric like EBITDA?
Great. Yeah, I can take this one. So most of these companies are not profitable on a GAAP basis. They don't have positive EBITDA. And the reason why we use EV to gross profit is because the way that the revenue contribution for these fintech companies works is that from revenue, what flows down to gross profit is based on their take rate. And all these companies have slightly different take rates. So by going, instead of using, for example, EV to sales, using EV to gross profit normalizes for these differences in take rate. And this is also the multiple most commonly used by the street in pricing companies in the space.
Hi, I have a question. If we were to look back on this 2 years from now and your investment case is wrong, what would be the primary reason why your investment case would not be correct?
I'm happy to start on that. So if you could go to thesis 1 with the correlation chart. So as we see in the upper right corner, there's a correlation between the states that have POS systems and GDP. So one of the reasons that we're expecting revenue to decrease is because the revenue per location is going to have to go down as they expand and try to penetrate low GDP states like the West and Midwest. Now, we think that they're going to have worse economics in establishing these locations because their chief revenue officer said that 80% of their sales to date have been from in-person sales forces versus just 20% over the phone, right? But this is going to be physically impossible or substantially more expensive as they go to more dispersed geographies. And so we think that it won't be as effective to have to try and sell over the phone. However, we could be disproven, and if we can see that they have a high conversion rate on their sales just based on phone calls, that is where we could be wrong.
Additionally, if we could go to the risk factors in the risk overview, there were 2 main things that we have also priced into our upside scenario in case of us being wrong. And this would be 1, international expansion, which could be deterred by cultural differences and overall pricing deterrence. And at the same time, their flywheel effect. So 1 out of 5 customer acquisitions comes from referrals. However, as we may know, referrals can be saturated pretty easily, and there can only be so many clients that you can gain from a simple call or a simple recommendation. So both of these factors were also baked into our valuation for our upside scenario, and we don't believe that they will create much of an impact when compared to our other thesis number 1 and thesis number 2 stipulants.
Thank you.
And just one last question on what for Toast here. What is their debt profile? I mean, how do you feel about their financial risk into this sort of higher growth period?
So I can speak on this. Toast has virtually no debt. So from a debt perspective, they have limited to no risk on a financial standpoint. Almost all of their minimal debt is just in leases, and it is a fraction of their total valuation and their profitability metrics. So from a debt perspective, we see very little risk on that front. And that is also not in influence over our valuation of the company.
Okay. And then how do they, let's say Square, like what's the key point of differentiation competitively? that you believe that were they're superior to others?
Yeah, so I can take this one. So Toast was the first restaurant-specific POS to start in the space. And that led to a lot of uptake initially, with particularly their Android system being a differentiator over iOS as it was more customizable. But now we've seen that innovation has become a level playing field. And really the POS systems have been competing on price. And in this graphic, you can see that Toast's monthly subscription fee is about $165 versus Square's monthly fee is only $60. And while Toast offers a lower take rate on transactions, in order to make up for the difference in take rate and the monthly fees, restaurants need to have roughly $35,000 per month in incremental revenue in order to make up for that difference. So when competing for pricing, Toast essentially is limiting their markets to restaurants that have over $1.5 million in sales annually. And as we've stated before, since they've already captured that low-hanging fruit in the Northeast region, it's going to become a lot harder to compete on price as they start to move to other regions. And if we can move to slide 58, I'd like to touch on one point in terms of the competition that they do have. So Shift4 Payments is one of the companies that have recently come out with a very similar product to what Toast offers, except they're able to offer it at about 1/3 of the price. They're expecting to add on 30,000 locations in 2024. And we're really expecting that as they provide more updates on the progress, that investors will start to see that the competitive moat that Toast has had in terms of technology has really diminished, and that as companies are starting to compete more on price, Toast's valuation multiple will contract.
Is there a network effect here that it makes the switching cost more burdensome?
So in terms of network effects, there has been one. It's been quite dense in, for example, the regions they've piloted, such as Boston. That's why we think as they go to more geographically dispersed regions where restaurants are further apart from each other, they're less likely to refer their friends who are also restaurant owners. Historically, 1 in 5 of their new onboards has come from a referral like this. Now, in terms of switching costs, yes, once a POS system is embedded in a restaurant, it's essentially the backbone of their operations, which we really learned through speaking with the 200 restaurant managers and owners. They said, you know, usually even if there's a small issue with the user interface or a little bit of downtime, it's never worth having to retrain their staff, having the downtime, having the actual, you know, payment of the new platform. And so usually it's a very sticky business model once it's embedded in a restaurant.
Okay.
On AI and these new trends, how do you expect AI and specifically the impact on the operating margin with the code generation to affect Toast business model?
I can take that. So AI is a bit of an interesting case within the POS space. We've seen from pretty much all of the competition, including Toast, that they have interest in implementing AI systems. However, most of these companies are also focused on cutting costs in their R&D and headcount at the same time. We all know AI is highly in demand, and so trying to get advanced team members within their headcount to work on AI products is very difficult and also expensive, especially when they're all trying to cut costs. We haven't really seen any of the competition, including Toast, come out with an effective product yet involving AI. So it's kind of yet to be seen what they can do with that. In terms of their own operations, there is the potential for AI to significantly reduce their R&D, but we haven't really seen this take effect yet within any of the competition, and it's still yet to be seen if it's really effective for the POS space as a whole.
Yeah, and maybe to add on that briefly, you know, we think that the majority of the expenses with their headcount comes down to sales, which is going to be hard to replace with AI. The main productivity increases will be software engineers being more productive, but at this point, the product is built out. It's more about spending on Salesforce.
And just to name an example of why R&D comprises such a heavy impact on the operating expenses as well.
Thank you, Babson College. At this time, the judges will take a few moments to collect their thoughts and make notes before the next university is brought in.
Thank you.
Thank you so much.
Thank you.
Thank you.
Thank you all. Good job.
Good job.
Welcome, FGV Sao Paulo. At this time, please launch your presentation and make sure it is working properly.
So can you guys see my screen here?
Yes. Yes.
Can we just check if everyone's mic is working okay before we start? So
Yes.
João, Nando, and Isa, please.
Hey guys, can you hear me?
Hi.
Yes.
Okay.
Perfect.
Please stay muted unless you are speaking. I will start time as soon as a member of your team speaks their first word. You will receive a 1-minute warning and time will end precisely at 10 minutes. Please feel free to begin.
Suzano, a giant in the pulp and paper industry, has been overlooked by the market despite its deep competitive advantages. Good afternoon. We are Fundação Getulio Vargas, representing CFA Society Brazil, and we are initiating coverage of Suzano with a buy recommendation and a 67 reais target price, a 27% upside from initiation. Suzano is the world's largest pulp producer, holding over 30% of the world capacity. The company has a very well-diversified global revenue stream, with a fully verticalized operation and integrated logistics, ranging from forest to cultivation with over 2 million hectares of land in Brazil to the delivery of several paper products. Climate change is a reality, and Suzano is part of the solution. With fossil-based materials at target, wood fiber became a prominent product in the development of sustainable alternatives, with over 10 million tons of competing addressable market to be generated in the next 10 years, placing the pulp and paper industry as one of the best commodities to be exposed for the longer run. Our buy recommendation lies on 4 key catalysts we believe the market has overlooked. First, Suzano holds an irreplicable low-cost position in Latin America. Second, in face of short-term challenges, the market is pricing overly pessimistic pulp prices into the longer run. Third, with accretive capex at the development of a new project named Cerrado, Suzano will become an even more resilient company. And fourth, the company is still under-recognized in terms of its ESG position.
Now, let's dive into our first pillar, Suzano's unmatchable position in Latam. With a massive size, Suzano is ahead of its competitors both in capacity and productive lands. But for the company, larger doesn't mean less efficient, as it achieves one of the lowest cash costs in the industry. But how is that possible? The answer is Brazil. Eucalyptus, the major raw material for pulp production, is not an easy tree to grow efficiently, needing very specific climate conditions. To measure that, we used work climate data to build a proprietary eucalyptus attractiveness index and concluded that Brazil is the only country that offers excellent climate conditions, adequate infrastructure, certified land, and geopolitical stability. Enjoying one of the best climates, Suzano's forests achieve an extremely high productivity in a shorter plantation cycle. In addition, the land availability in Brazil makes it possible for Suzano to use its own wood as a primary source, reducing costs and protecting it from rise in wood prices, ensuring excellence on its return on invested capital. But how deep is Suzano's moat? Farmland prices in Brazil have tripled, just after Suzano's major acquisition of land in the merger with Fibrio. So, we used web scraping to develop a land valuation analysis of Suzano's current forests and estimated that, with a market price of 50 billion reais, it takes over 4 times the EBITDA of the second largest player to replicate Suzano's position, assuring its irreplaceability. Still, when you look at the trailing EV/EBITDA premium to international peers, the market doesn't seem to properly recognize Suzano's position, with a discount below 1 standard deviation of the average.
Moving on to our second pillar, we see overly pessimistic pulp price expectations, providing a good entry point to Suzano. Pulp prices behave in cycles, with capacity additions being announced at high prices and high-cost producers getting out of the supply network during market downturns. This poses the industry cash cost as the lower bound of pulp prices downward spirals, being a natural gross margin advantage for Suzano. Currently, we are watching the rollout of 3 major projects in Latin America, making the market question whether pulp demand is capable of absorbing this new capacity. But is this fear reasonable? To address this question, we built our proprietary supply-demand model, in which we do recognize a challenging short-term for Suzano, with an oversupply in the next 2 years. However, the future lies in 2 key points the market is missing. Will there be space for new capacity additions in Latin America post the oversupply, and how will key demand drivers develop? By mapping all eucalyptus plantations in Latin America, we concluded that, after Cerrado's rollout, no country will have sufficient wood supply to accommodate another big pulp project. This difficulty should benefit highly integrated players on wood, such as Suzano, who is sitting on an industry that should catalyze growth from azed tissue consumption and fossil fuel substitution. But even with all these positive catalysts, the market seems to be swapping the long-term position for short-term uncertainties. Suzano is currently trading at an implied 540 pulp price, a level well below both historical average and our forecast of 575, creating a margin of safety for the investment in Suzano.
In our third thesis, with Cerrado, Suzano's new pulp project, the company will enhance not only production, but also efficiency gains and results protection. The results of pulp and paper companies are volatile and entirely driven by variation in pulp prices. In low cycles, margins are compressed and performance is significantly impacted. In this scenario, the only way to guarantee resilient results is by minimizing cash cost, and for us, this is the main advantage of Cerrado. More than a 20% increase in capacity, Cerrado will provide superior energy generation and new logistic solutions. Also, the distance from forest to mill will be reduced to 65 kilometers, the best in the market, meaning more efficiency and a huge reduction on cash cost. So, to effectively measure this efficiency, we analyzed what would be Cerrado's performance with the lowest pulp price of the past years. And in this scenario, Cerrado would generate a 19% free cash flow margin compared to 4% of current mills. However, cash generation does not necessarily mean a good project investment, but for Cerrado, the 22 billion reais capex was worth it. Consider sensibility on dollar and pulp prices, we estimate that the project does not generate value only with very pessimistic assumptions. So, why does the market still doesn't value Cerrado? It's always something leverage. Historically, projects of great capacity have resulted in an average rise of 1.4 on companies' net debt to EBITDA. However, for Suzano, this hasn't been a reality. Suzano announced this new project while still in a deleveraging process after the Fibra merger, but we don't see that as a stoppage. For us, accounting for Cerrado capex without considering the project EBITDA generation is not correct. So we made this adjustment and saw that the company is still following this debt reduction trend.
We also observe Suzano's ESG efforts, which we believe are not fully recognized. Suzano's core business is ESG-centric, and our proprietary analysis confirms that. The company excels in supply chain management, biodiversity, and carbon reduction. It also excels socially, leading in labor management. Governance-wise, Suzano shines with a qualified board guided by a respected family, earning a top score on our 18 criteria ESG index. The company effectively turns its ESG commitments into tangible benefits, showcasing one of the sector's lowest cost of debt through efficient use of ESG-related bonds. This excellent position made us apply a discount to Suzano's cost of equity, based on the paper establishing ESG as a risk premium. By factoring Suzano's advantages in both cost of debt and equity, we estimate that Suzano generates over 6 billion reais with its commitments. But with all those efforts, why under-recognized? It all relies on MSCI rating. The agency punishes Suzano in aspects that it excels, and we see Suzano's big improvements in biodiversity and land use, and a creative ownership by the Pfeffer family's expertise and long-term alignment, evident by major executive compensation being variable over the last 3 years. Thus, we believe Suzano could undergo a re-rating soon. In view of our proprietary analysis of over 60 ESG-exposed assets, Suzano could appreciate through this possible re-rating and also benefit from the increase in ESG investors, especially those mandated with MSCI rating. Suzano has an unexplored potential in Brazil carbon market, which is set to unlock a 10 billion reais market for the company, being a big upside risk, reinforcing our thesis that Suzano's ESG is under-recognized.
Now, accounting for all those catalysts, we used a blended valuation approach to reach a 67 reais target price. This is the output of a free cash flow to equity DCF, a relative valuation considering historical EV to EBITDA discount to 3 different geographical peer sets in a sum of the parts, in which we value Suzano's current pulp business, paper, and its new initiative in Cerrado from a granular bottom-up financial forecast. Getting into the numbers, we expect a modest 3% revenue CAGR from the cycle peak of 2022 to 2033, mostly driven by the roll-off of Cerrado, pulp price normalization, and the paper mix diversification, with margins stabilizing below the price peak of the last 2 years. We incorporated the pillars of our investment recommendation to several of our forecasts, where Suzano will further strengthen its position within the industry and normalize its margins post-2025, with a 575 long-term pulp price extracted from a proprietary supply-demand model. Even though we applied conservative assumptions, we stressed our model for different possible outcomes, where Suzano could underperform in a scenario considering structurally lower pulp prices or a significant appreciation of the Brazilian real against the US dollar, which are the 2 most sensitive assumptions to Suzano's business. Addressing the most significant risks to our recommendation, we see lower pulp price for longer and a possible bad capital allocation strategy after Cerrado as the most significant for the company. However, we see those as highly unlikely, as our proprietary supply-demand model indicates a normalized scenario post-2025, and consider the excellent track record of good decisions made by the management.
The key to thriving in commodity markets is not to predict cycles, but to overcome them. And Suzano gives a masterclass on it. We reiterate our buy recommendation due to Suzano's unmatched low-cost position, pessimism regarding pulp prices, a new project to get through future cycles with stronger cash generation, and its under-recognized ESG position, with potential to enhance benefits from green capital markets. Thank you, and are open to questions.
Thank you. Judges, at this time, please turn on your video. Please stay muted unless you are speaking. I will start time as soon as a judge speaks the first word. The Q&A period will be at least 10 minutes. If it is still going after 10 minutes, we will continue for up to 15 minutes total. If any time after 10 minutes, the judges have no remaining questions, we will end the Q&A period before 15 minutes. Please feel free to begin.
I'll go here. This question on their revenue, so their business mix for their revenue, is it, how is that, do you have a slide that shows us kind of their revenue breakout by segment or?
Sorry, if you can please move with me to page, it's 132. So this is basically the distribution of revenue from the segments. We broke down in our forecast revenue from pulp, which is wood fiber that it produces from its own eucalyptus, paper, which is the fully verticalized paper products that it produces, so, such as tissue and printing and writing paper. And we also broke down what would be the revenue of its new plant coming in, that is Cerrado, that is represented here. So this is the breakdown of the revenue.
And do you see going forward, or has the company talked about sort of just continuing to focus on these areas, or are they looking for other growth opportunities to grow their revenue at a higher rate?
Okay, so thank you for your question. If we could please move to page 121. So Suzano has been a company that has been investing in innovation since its foundation, but right now they're investing in a few new addressable markets, which are textiles, microfibrillated cellulose, biofuels, and also the carbon credit market. So despite having a really big focus on pulp and also expanding on paper, they also have attention for these new initiatives.
Do you know, from a geographical point of view, are they primarily focused in South America, or are they international?
Yeah, thank you for your question. And if you could please move with me to page 2. So yeah, Suzano is primarily focused internationally, especially in China, which represents the majority of its revenue, but also Europe coming in second place. But also Suzano has sells its products to Brazil and North America, especially paper. So we see that it's a company very international, especially when we consider pulp.
Do you see any risk in that, or are you concerned at all about their exposure to China?
Okay, thank you for the question. That's an excellent one. Excellent question. If you can please move to page 128. So basically, we see that historically, China has been the main growth for pulp consumption. So we can see in this graph from the left that the percentage of China for all pulp consumption in the world has increased a lot recently. However, not only that, but Latam is from year by year becoming the highest supplier of pulp to China. So why is that a significant point? Because as we've mentioned, a great strategic of being located in Brazil is that Brazil has no geopolitical instability with any other countries. So we see this, China is not a risk since Brazil is not involved into geopolitical instabilities with China. What we see is that maybe there could be some risk into demand growth due to China's current situation, which is not excellent. However, we don't see this as a big problem, as paper is a very stable product. So the paper consumption is very stable, so it shouldn't affect too much Suzano's the demand of the market for pulp.
Okay, thank you.
Hi, could you assess the company's susceptibility to increased regulation from a global perspective in reaction to climate change?
Yeah,
Okay,
sure.
so you can go,
can go.
Bruno. You can go.
Okay, so if you can please move with me to page, let me just find the slide here. So basically concerning regulation, Suzano enjoys a different tax rate from the Brazilian current tax rates due to it's having a holding company in Europe, in Austria specifically, where it does its trade. We are not concerned about, we do not concern our recommendation due to regulation regarding carbon markets, specifically for a higher tax rate on Suzano, for example, due to it being a carbon positive company. So despite its business being cutting down trees, the trees it plants sequestrates carbon from the atmosphere. So it's a carbon positive company, and if it should have any effect, it should be from Brazilian regulation regarding the carbon market. So regarding the trade specifically, Suzano is to benefit, not to be prejudiced by any changes in regulation involving carbon.
Okay, thank you.
I can go again here. Just so on there was a slide on your ESG you had where it was talking about weighted average cost of capital, I believe. And I was looking at that. Yeah, here we go. So I found the kind of the bottom right without ESG and with ESG. Can you kind of talk through your process there?
Yes, sure. Thank you for your question. So, as we said in our presentation, Suzano is able to materialize its ESG commitments into tangible benefits, and we managed to reflect that into Suzano's cost of capital through two main ways. The first one was through cost of debt, since Suzano emits a lot of ESG-related bonds, and they have a significantly lower coupon compared to traditional bonds, and this reduces a lot Suzano's cost of debt, since 39% of Suzano's debt structure is related to ESG bonds. And also regarding cost of equity, we applied a 0.18% discount into Suzano's cost of equity based on a paper named Establishing ESG as a Risk Premium, where Suzano was positioned quite well relative to its peers, and a 1% deviation from the sector mean equaled a 1% premium on the cost of equity. So that is why Suzano's weighted average cost of capital would be different if it didn't have any ESG commitments versus having these ESG commitments in our study here.
Yeah, and if I may just add on to the answer, the 6 billion reais on ESG and PV was, we considered what would be the company fair enterprise value considering its WACC with ESG bonds, and we considered what would be the WACC, the weighted average cost of capital, if Suzano did not have those ESG benefits. So applying this WACC without ESG benefits, the company would lose 6 billion reais in enterprise value within our model. So we reached that would be the net present value of its ESG commitment. It is just an estimate regarding our model.
Okay.
If you are wrong on your buy case, what would be the principal reason?
Okay, that's an excellent question. If you can please move to page 112. So basically, there are two main risks that would change our buy recommendation to a sell one. First one is the oversupply into the pulp market. We see a lot of announced of pulp projects currently in the last years, and we see that maybe if those additions continue to keep growing, this would cause an oversupply in the market and therefore a reduction on pulp as normal supply and demand, and this would make us to change to a sell recommendation. Another point that is correlated to the first one is Suzano's capital allocation. As we've mentioned, oversupply would be very harmful for the market. So we see that if Suzano continues to invest in new pulp projects, at least in the next years, in the midterm, this would be harmful for the company and the overall market. So we see that an ideal capital allocation for Suzano would be now to distribute dividends back to the shareholders. So those are the two main things that would change our buy recommendation to a sell one.
Thank you.
I just had one last one here. On your valuation, can you walk us through that real quick? I know you did in the presentation, but kind of your recommendation was a buy. Is that a recommendation on based on valuation or based on your fundamental optimism of the company?
Sure. If we, I may just answer this question. It's a very good question. So our recommendation is based on both. We believe Suzano is one of the great companies here in Brazil and one of the most well-managed ones. And it has such a unique position in Latin America that it makes it a fairly competitive company, the most competitive company within the pulp and paper industry globally. So we ponderated this within our analysis, and we incorporated this into our valuation model. However, we view that many of Suzano's qualities are still not being fully recognized by the market. That being, first, it is irreplaceable low-cost position in Latin America, where you can see that no company would be able to buy out its current position at production in Latin America. Second, being pulp prices, where investors mostly are very pessimistic about regarding the long-term future as new capacities are getting on, that we believe is going to have a greater challenge to find the available wood supply to accommodate those projects. So we believe the market is overly pessimistic on that one. And third, being its under-recognized ESG position, which is going to be a much more relevant aspect when we look into the long term of the case. So we believe there are, within the two, the quality of the business and the valuation, we believe that Suzano is a great company regarding quality, and it's currently under-recognized in terms of some of its key aspects.
Okay, thanks. I didn't have any further questions.
Judges, if there are no remaining questions, we can go ahead and conclude the Q&A period.
Good job, team. Thanks.
Thank you.
Thank you.
Thank you.
Thank you, FGV Sao Paulo. At this time, the judges will take a few moments to collect their thoughts and make notes before the next university comes in. Welcome, University at Albany, SUNY. At this time, please launch your presentation and make sure it is working properly.
All right, I just shared my screen. Can you all see it?
Yes.
All right.
Please stay muted unless you are speaking. I will start time as soon as a member of your team speaks the first word. You will receive a 1-minute warning and time will end precisely at 10 minutes. Please feel free to begin.
Good afternoon. Today, Team U Albany will be presenting our equity valuation of Dollar Tree, Inc., which we are recommending as a buy with a 12-month price target of $150. My name is Noel, and I'm with Kevin, Sophia, Ashar, and Tyler.
Dollar Tree, Inc. is a U.S.-based discount variety retail store headquartered in Chesapeake, Virginia, that operates in two segments, its Dollar Tree segment and its Family Dollar segment. The Dollar Tree segment has a diversified product mix that includes consumables merchandise, variety merchandise, as well as seasonal goods. The Family Dollar segment has a similar product mix, but also includes home products as well as apparel and accessories. As of the end of 2023, the Dollar Tree segment and the Family Dollar segment had a similar number of stores operating. But as you can see, the Dollar Tree segment tends to generate higher revenues and higher margins than Family Dollar, accounting for 54.8% of revenues in 2023.
Turning our attention to the top left, we expect the total number of stores to increase well into 2028, with the majority of the growth coming from the Dollar Tree segment, whereas management has recently announced the closure of 600 underperforming Family Dollar stores. Moving to the geographic map on the right side, the distribution of stores very well represents where the current population centers are and where they are migrating to. Lastly, to highlight the chart on the bottom left, we notice an increase in overall market share, ending at 30% in fiscal year 2023.
We will now shift our focus to our investment thesis, which we base on the company's strategic initiatives and split into 3 pillars, which we ultimately believe will drive sales growth and profitability for the company over the next few years. The first pillar being the new pricing strategies, the second pillar being the innovative new store formats to enhance customer value, and the third being the supply chain initiatives to increase operating efficiency. In our first pillar, we focus on the Dollar Tree segment's 2 distinct pricing initiatives. The first being the Dollar Plus, which raised the base price point of its products from $1 to $1.25. And then more recently, the multi-price strategy, which raised the base price point of its products from $1.25 to a variety of $3, $4, and $5 products, with an initial focus on the frozen section. In 2024, Dollar Tree aims to target consumables and discretionary products with its multi-price strategy, with prices ranging from $1.50 to $7. In the top right, you can see the implementation of the multi-price strategy in its frozen section, with an initial, within the past, 10 doors being at the $1.25 price point, but in the future, in the typical 10-door cooler section, Dollar Tree aims to have 8 doors of the 10 at the $3, $4, and $5 multi-price point. In the bottom left, you could see examples of frozen products in Dollar Tree. And on the left, you could see the $1.25 frozen products, which tend to be single-serve meals. And on the right, you could see the multi-price frozen products, which tend to be multi-serving meals. This brings us to our second pillar, where we focus on the Family Dollar segment's 3 new and innovative store formats. The first being the H2.5, which is its primary new store format. The second being the Rural Stores format, which is larger than the H2.5 and tends to include Dollar Tree and Family Dollar products and is larger than the H2.5. And the third being the extra small box format, which is smaller than the H2.5 and is implemented in urban settings. In the chart in the top right, you could see Family Dollar's 3-pronged initiative to enhance value. The first being the transition from control brands to private labels, and the second being the addition of gondola units in its stores, which it recently completed in 2023, and raised the base shelf height from 72 inches to 78 inches, allowing for a wider assortment of products. And then on the bottom right chart, you can see that Family Dollar plans to have 1,000 project renovations per year over the next 3 years, and Dollar Tree plans to roll out its multi-price initiative in 2,000 stores per year over the next 3 years. For our last pillar, we'll focus on Dollar Tree's 2 key supply chain initiatives. First, on the top left, you can see the dual banner distribution center, which it recently constructed in Ocala, Florida, and is the first of its kind, as it includes both Dollar Tree and Family Dollar products, whereas all other distribution centers only serve one segment or the other. And then on the top right, you can see that Dollar Tree has implemented a fleet ownership program, and Family Dollar has implemented a modernization initiative to upgrade its currently existing fleet.
Now for an overview of Dollar Tree's management team, who has had a relatively short tenure starting within the last 2 years. Despite this, we believe that their years of proven industry experience will allow them to use their expertise to be good stewards of the company. Under this team, many new growth initiatives have been pursued, and we expect these to bear fruit in the coming years and return value to shareholders.
With the context of our investment thesis in mind, we can now review our financial projections. Based on management's guidance, our own analysis, and the company's strategic initiatives, we believe that Dollar Tree as an enterprise will be able to achieve strong EBITDA, net income, and earnings per share improvement over the next few years. But what we really want to highlight on this slide is the bottom 2 charts, which break down the Dollar Tree segment and the Family Dollar segment in terms of revenue, gross profit, and gross margins. As you can see, the Dollar Tree segment tends to be their profit maker with mid-30 margins, while the Family Dollar segment on the right-hand side tends to lag behind with mid-20 margins. We believe on a go-forward basis, both segments will be able to improve their overall margins, as Dollar Tree has already seen higher traffic as a result of their multi-price rollout, and Family Dollar will see even further margin improvement on the back of their private label offerings, new assortments, and new store formats. We took 4 different valuation approaches in order to value Dollar Tree shares. The first was a DCF valuation, where we arrived at a price target of $147.41, representing upside of approximately 9%. Our second approach was a sum of parts valuation, where we arrived at a price target of $145.22, representing upside of approximately 8%. The lower price target here is likely a result of the lack of free cash flow in the early years of the valuation in the family dollar segment, although we do expect this segment to be increased profitability over the next few years. Our third approach was a historical multiples valuation, where we arrived at a price target of $137.06, representing upside of approximately 2%. In this valuation, we use an adjusted price to earnings, adjusted enterprise value to EBIT, and an adjusted enterprise value to EBITDA. Lastly, we use a comparable multiples valuation to arrive at a price target of $167.86, representing upside of approximately 25%. I'd like to point out that in this valuation, we opted to only use dollar store peers, Dollar General, and Dollarama in the actual price target output, but have listed some aspirational peers on the right-hand side. By weighing all four of our valuations equally, we arrive at our 12-month price target of $150, representing about 11% upside. Hence, we are recommending Dollar Tree shares as a buy.
Now moving into ESG. So this first point represents Dollar Tree's most recent environmental policy. They announced their chemical and electronics recycling program, which reduces labor costs and compliance costs relating to disposals and waste management. They also continuously highlight the importance of LED lighting and energy management systems throughout their stores in order to continue to lower costs and reduce emissions. In 2022 alone, Dollar Tree has opened over 400 new stores to comply with their in-store energy efficiency standard, investing a total of $45 million into these upgrades. The next point is Dollar Tree's net zero commitment. So this is broken down into three scopes. The first is direct emissions. The second is indirect emissions from heating, cooling, and electricity. And the third is indirect emissions from all of their daily operations, which they expect to reach by 2050. Dollar Tree has a strong commitment to this plan, and in 2022, they have recycled over 370,000 tons of cardboard, paper, and plastic. Dollar Tree also has a strong commitment to diversity. Dollar Tree has the most diverse customer base in retail, with 50% of Family Dollar and 37% of Dollar Tree sales coming from non-white shoppers. Additionally, 56% of employees within the company are ethnically diverse. In the area of governance for Dollar Tree, most sources give a mixed bag of scores, but overall their ratings seem to excel in audit and shareholder rights due to their transparent financial reporting, compliance with regulations, and active shareholder engagement. Now moving into risks. So the first point is Dollar Tree's exposure to inflationary risk. Higher inflation can cause them to have higher operating costs, and it can also deter consumer spending in the stores. The next point is supply chain difficulties. Since Dollar Tree has high exposure to China, this imposes political risk, which can lead to them not being able to get their products at a reasonable price, and it can also cause slowdowns in merchandise shipping. The next point is store expansion risk. If Dollar Tree is not able to reach their net store growth targets, this can cause them to miss on their sales expectations.
1 minute remaining.
Next is consumer trends. Dollar Tree's products tend to contain high amounts of sugar and fat, while more recent trends suggest that consumers are tending to move towards more healthful products. The last point is shrinkage levels in both Family Dollar and Dollar Tree stores, but it's putting a greater pressure on Family Dollar stores. Management has extensively spoken about the increased theft throughout their stores, which has materially affected Dollar Tree's EPS.
To reiterate, we are recommending Dollar Tree shares as a buy with a 12-month price target of $150. That concludes our presentation. Thank you, and we're happy to answer any questions.
Thank you. Judges, at this time, please turn on your video. Please stay muted unless you are speaking. I will start time as soon as a judge speaks the first word. The Q&A period will last at least 10 minutes. If it is still going after 10 minutes, we will continue for up to 15 minutes total. If any time after 10 minutes, the judges have no remaining questions, we will end the Q&A period before 15 minutes. Please feel free to begin.
I'll start here. Question on, there was a slide you had where it was comparing the two store formats and their relative profitability. Do you mind to bring that up?
Like Family Dollar versus Dollar Tree?
Yeah.
Was it in the appendix, or was it a page or was it a slide we went over in the actual presentation?
No, it was a slide you went over. Showed like the, I think, revenue and gross profit maybe.
Oh yeah, right here.
Yeah. So, and then later, I think you went on to why Dollar Tree is more profitable than Family Dollar. is that something you could walk me through again there, just why the two, like why are they so much more profitable for Dollar Tree?
Yeah, I mean, that's likely a result of the products that they sell, right? So Family Dollar, about 80% of their sales are from consumables, as opposed to Dollar Tree, where it's about 50-50 split between discretionary and consumables. Dollar Tree benefits from those, higher, the higher amount of discretionary products, and those products have higher margins. But Family Dollar, on the other hand, I mean, for example, because they benefit, although they have lower margins because those products, which are consumables, have lower margins, they do benefit during like recessionary periods. For example, in 2008, Family Dollar actually performed exceptionally well.
So on the there was a chart you had, it showed a map, and I believe it showed there's it was towards the beginning, yep, right there. And so we have a lot on, call it east of the Mississippi, and not so much west of it. So is that a focus for them to get more into, especially, I think you mentioned their customer base is more diverse. Is there a drive to expand that footprint?
I think there's kind of two answers to this, two kind of related things that I'd like. So the management hasn't specifically given guidance on where they plan to open stores. All they have mentioned is that they, as after these Family Dollar store closures in the first half of 2024, they'll likely be around a little bit under 16,500 stores. But they believe the market can support 25,000 Dollar Tree and Family Dollar stores in the United States. So that's one thing. But also, if you look at Dollar Tree versus Dollar General, both are taking very different approaches in terms of opening stores. Dollar General seems to be focused on rural areas, while Dollar Tree is focusing on suburban and urban areas, which they've seen a higher sales growth when they've done renovation and new store openings.
And just to add to that, specifically with the Family Dollar segment and the rural store format, which includes both Dollar Tree and Family Dollar products, we see that being implemented more west of the Mississippi, and that will compete with Dollar General, which typically is in rural areas.
Do they share? You showed a distribution center. Is that part of the thesis too, that they're pretty cost effective when it comes to managing, their infrastructure?
Absolutely.
Kevin, do you want to take that one? Yep.
Absolutely, yes. So we think that by having both banners, as they describe, Dollar Tree and Family Dollar in one facility, it absolutely drives efficiency in being able to get the products from, especially with that rural store format, where we can have both products from both banners delivered to the same store.
And I just wanted to add on to that. One thing that they've really highlighted with the new DCs that they're opening is cutting down on the how far their tractors have to drive now in order to deliver products. So they're being very strategic about where they're placing the actual DCs.
Okay, and then last one here, there was a chart you showed the Dollar General versus Dollar Tree versus Dollar General and some other competitors. So yeah, it was right there. And so if you look at on valuation, on relative valuation with price to earnings, you have Dollar Tree higher than, say, Dollar General. And so why do you think that would be the case?
Yeah, I mean, I think there's one is like, I think when you're looking at this from a comparable standpoint, we've listed 3 valuations, but the best way to look at this is terms of like EV to EBITDA. Like, so these companies will trade to like 12, 13 times EV to EBITDA or on like a normal year. But one thing in terms of PE is Dollar General's actually seen a decrease in their comp sales as a result of their new store openings. On the other hand, Dollar Tree has only seen higher sales. They compared to Dollar General, they were up 5.8% in 2023 compared to Dollar General. They were down 0.2%. So they're really outperforming in that end. And I think investors are really excited about their progress on that end. I'm not sure if anyone else on my team wants to jump in on that.
I'd like to I could add to that. And then if you kind of like look at the KPIs, if we could go to the KPI slide in the appendix, if you kind of look at the comparison between Dollar Tree and Dollar General, obviously same store sales growth for Dollar Tree is much higher than for Dollar General, where in 2023 it was about 4.5% for Dollar Tree and only about 0.25% for Dollar General. And then in the bottom left corner, you could see the sales per square foot, where Dollar General typically has higher sales per square foot than Dollar Tree, but it has been stagnant over the past 3 or 4 years. Whereas for Dollar Tree, it has sequentially or annually year-over-year increased compared to Dollar General. So we see that as a positive as well.
Okay, thanks.
I had a question. If you go to, in your appendix, the store count slide, because I see that you are growing year over year, same store sales, even though you also mentioned that they are expanding into rural and suburban areas. Wouldn't you think that the revenue per store would be lower because they're going into, a different geography?
So are you asking like if the revenue per store would decrease as a result of them open? Okay, so that's a great question. Thank you. So one of the main drivers and the reason why we see the revenue per store increasing over the next few years, there's really 2 main points. One, they're being very creative about their strategies. The private label offerings are attractive to consumers. The multi-price initiative has already brought traffic in those Dollar Tree stores up. But another really interesting point is that on their recent earnings call for 2023 Q4, they announced that they'll be closing 600 underperforming Family Dollar stores, which had a annualized loss of $74 million, which is going to save them about 30 cents in the bottom line. But yeah, some of those stores were really losing money, and we see it as a huge benefit to them. They're closing the underperforming stores. They're likely going to recapture all those stores that were closed because they might have been closed because a Dollar Tree is right down the road. So we see that as a benefit and allowing them to increase their revenue per store on a go-forward basis.
To add on to what Noel said, like the Dollar Tree's rural stores have seen an increase of over 20% with this new store format per store. So once the management introduces all the changes that my colleagues talked about, the revenue per store jumps by 20%, which is why we think they could support increasing revenue per store over the next few years as they do more of these renovations. Then they'll be done by 2026.
And just a follow-up question to that, do you have that breakdown on how much of the new revenue is coming from those price increases, that revenue growth, and how much is just from scale and becoming a larger company, a larger business?
Yeah, maybe my colleagues can answer this a little bit better regarding the multi-price, how that's impacted. But I know for one of the huge ways that multi-price has benefited them in terms of the average basket is they saw a 37, for example, during the holidays, an example, Halloween, they saw a 37% gain as a direct result of their multi-price products. So where these multi-price products seem to be having the biggest impact is in the holidays, and also consumers who are making over $125,000. They saw a $3.4 million 3.4 million new consumers, likely all with household incomes of above 125,000 in 2023, and we see that as a huge benefit.
Hi, could you address where you think your bull case differs most from consensus?
Sorry, can you repeat that? It didn't really.
Sure.
Our bull case on our valuations?
Correct. Where does your bull case differ from consensus, first of all?
Yeah. So in terms of our 12-month price target, we're about middle of the pack in terms of where Wall Street is projecting. Tyler, I know you were looking at this recently. Would you want to jump in on that?
Yeah, absolutely. We have a lot of confidence. Like we know that we lowered our price target. So our original price target was 160, but after the impairments that Dollar Tree suffered in Q4 last year, we decided to adjust down our price target to 150. So our bull case is that these impairments were a one-time expense. Like obviously they spent over $1 billion in impairment charges to write off these underperforming family dollar stores, but management has said that should give them a recurring EPS gain of like around 30 cents in the long term. So we think that the stock price is depressed now because of like these impairment charges and like the changes that their management's making is it's still taking time for them to be fully recognized. But as for the bull case, I think we're in the middle of the road. There's analyst price targets from 130 to like 180, and we think a fair price target is around 150, knowing all everything around.
Thank you. If we were to have a crystal ball and think about 2 years hence, and your investment case is wrong, what would be the principal reason?
I think it'd be that management couldn't execute the changes that they've promised to investors. Like, there's a lot of this new management team. There was a shakeup in 2022 because the old management team was underperforming, so they have a completely new C-suite. They've promised a lot of things, and there's been great progress so far. But if this progress were to stop and like things got stagnant, that'd be in my opinion, the reason why the thesis would fall apart.
Sophia, would you like to add a little bit about shrinkage?
Yeah, so recently in their most recent earnings call, they kind of spoke a lot about shrinkage because it was like a big deal for them. It actually decreased their full fiscal year EPS by about $1.15. But they also announced like some ways that they're gonna prevent that. One is like this like anti-swept panel, which makes it so when you're taking out products off the shelves, you can only take one off at a time. As opposed to being able to just take the whole shelf off, basically.
I see. Thank you.
Thank you.
I had another question regarding CapEx. I can say that you are projecting a significant decrease in the CapEx requirements for the company, even though the number of stores that they open, it's growing. Can you further explain that?
Yeah, so our CapEx guidance is that's one thing we've really listened to management on. They're pretty, they give, pretty, like.
We have a variance to show them if you want to show them the management.
Yes,
variance.
yeah, we can definitely show that. So in terms of CapEx, we're projecting about 2.2 billion, and management's guide about 2.2 billion. But I know going forward, in 2025 and 2026, they projected about 1.8 billion, which we also have. If you look at our DCF, you can see that we have CapEx of like 1.8 and a little bit under 1.8 the following year in 2026. So we're really listening to management in terms of guidance on that.
Wouldn't that affect the number of stores that they're able to open?
Well, a large part of their CapEx. A large part of their CapEx expense right now is all these renovations. So when they finish in 2026, their CapEx expense will drop significantly because just to open the stores by themselves is not as large an expense as to renovate 8,000 stores to be to these new standards of management.
Yeah, about 40% of their CapEx right now is being used for renovating those stores that they're discussing, and they plan to have all these renovations done by the goal is to have them done by 2026.
I don't have any more questions.
Good. We can go ahead and call the Q&A. Thank you, University at Albany, SUNY. At this time, the judges will take a few moments to collect their thoughts and make notes before the next university is brought in.
Hello?
Hello. Welcome, University of Denver. At this time, please launch your presentation and make sure everything is working properly.
Thank you. Do you see the screen?
Yes.
All right, perfect.
Okay. Please stay muted unless you are speaking. I will start time as soon as a member of your team speaks the first word. You will receive a 1-minute warning and time will end precisely at 10 minutes. Please feel free to begin.
Hi. Before we begin, one of our teammates had a family emergency and was unable to attend today. Now, I'd like to thank the CFA Society and our judges for taking their time today
We're the University of Denver, and today we are issuing a buy recommendation for Walmart at a target price of $66.70, which represents a 13% upside as of market close April 3rd. My name's Evan Brink. This is Jaden Anderson, and Jake Martin was unable to attend. And today we will show that the market does not accurately price in Walmart's e-commerce and advertising business segments. Additionally, we will show that Walmart has defensive market characteristics strengthened by its ability to capitalize on ESG initiatives. And I'll pass it off to Jaden to introduce Walmart.
Thank you, Evan. When you walk into a Walmart, you're walking into a grocery store, an appliance store, a clothing store, a pharmacy. I mean, it's a lot, and you can't really put Walmart into one box, which is why we opted for a sum of the parts model for our valuation. Walmart's the largest company by revenue, the largest non-government employer in the world, and have segmented operations primarily between domestic retail, international retail, and e-commerce and advertising. Their massive size and strength shows in their historical stock performance, as they have had consistent and rigid returns, especially when mapped against the S&P 500 and the S&P 500 Consumer Staple Index, in which they dominate. Now, diving into some competitive positioning and following the organization of our sum of the parts, first starting with domestic retail, we know Walmart flat out dominates. I mean, 90% of Americans live within 10 miles of a Walmart, and they control over 25% of the US grocers market share without even including Sam's Club. Internationally, Walmart has had some difficulties entering new countries due to cultural myopia, which Evan will get into shortly. However, has seen strong and consistent growths in their top 3 operating countries over the past 3 years. Lastly is e-commerce. Walmart has seen massive growth both in revenue and e-commerce penetration, and this is where we see the biggest growth opportunity for Walmart. It's extremely difficult to enter e-commerce. Instacart's CEO came out and said how it took them 100 million orders before they were able to turn a positive unit of economics, and that, quote, scale matters enormously. Luckily for Walmart, they already hit 100 million orders a year easily. They already have the scale in place that they can really use to leverage growth in e-commerce, of which they're already seeing growth.
Thank you, Jaden. And diving into our financial analysis today, and continuing with our sum of the parts methodology, we segmented Walmart's peer group into 3 areas: domestic retail, international retail, and e-commerce and advertising. Then we created a synthetic Walmart equivalent by weighting these segments based on Walmart's 2023 net profit distribution, where domestic retail composed 73%. Then we conducted a ratio analysis and found that Walmart was in line with its synthetic equivalent on key ratios. From this analysis, we pulled out 3 important considerations for our valuation. 1, e-commerce peers have a higher gross margin and a lower return on assets. 2, international peers average a lower price to earnings ratio. And 3, domestic retail peers average a higher earnings per share. As we will show, we expect Walmart's revenue mix to change over the next 3 years, and these considerations helped inform our valuation. Now, moving on to our investment thesis and valuation, I want to begin by showing that Walmart has seen substantial growth in their high margin business channels, and we expect substantial EBITDA uplifts moving forward from this growth. Our value creation hypothesis is simple. We expect expansion in Walmart's e-commerce platform, Walmart Plus. We've seen significant growth over the last 5 years. 2, we see tailwinds behind Walmart's infrastructure investment. Walmart has invested in building out new stores in the US this year and next year. And while that does expand the brick and mortar platform, what it does is it provides a more effective and efficient e-commerce experience for consumers. Yes, each of those stores serves as a node on Walmart's transportation and logistics platforms, enabling better service for end customers. 3, we see the building blocks of 3P finally getting put into place. The growth from a 1P to a 2P business to a 3P business is clear, and we expect that to come to full fruition within the next few years. Additionally, we want to discuss advertising and Walmart's ability to capitalize on the changes in the advertising market. While in the past, retail advertising was done by consumer staple companies purchasing end caps at the end of aisles, big paper signs that were installed for consumers to see. However, now the transition to digital advertising, both with digital signage and with digital ads on the e-commerce platform, enable not only more profitable advertising, more dynamic advertising, but more valuable advertising data for the advertising customers. Now, we want to discuss some flywheel effects of this circular initiative. And two, we see Walmart's dominant size and scale. I mean, it's the 800-pound gorilla in the room, and it can capitalize with extreme control over its fixed costs, like labor and others. Within its value drivers, like we discussed, retail advertising is key. It provides valuable data-based information that Walmart is able to monetize through its partnership with Trade Desk, which works with the likes of Uber, Target, Lyft, etc. We see strong flywheel momentum as Walmart's e-commerce growth fuels an expansion in their store network, more efficient utilization of the product on the shelves. We see this growing Walmart's Walmart Plus program, which fuels a retail media advertising spend and builds out new profit pools for Walmart to take advantage of. Now, you may be asking, who is going to lead these growth initiatives? Who's going to take advantage of this potential? And we see Walmart's management team as forward-looking and world-class. They're clearly capable of this. Within the past, we saw them strategically position Walmart through key acquisitions, such as Flipkart in India and Vizio Holdings most recently. Now I'll pass it off to Jaden to talk through our valuation.
So looking at our model, once again, we used a weighted sum of the parts model that gave us a weighted target price of $66.70, representing a 13% premium. Specifically, we did a blend of 60% weight on our sum of the price DCF and 40% on our sum of the parts relative valuation. We did this due to the nature of Walmart. They're an extremely mature company that has seen extremely stable and consistent cash flows ever since I've been born. And we expect this trend to continue in the future. So we felt it'd be more appropriate to put more weight on the DCF, which now looking at our DCF, we broke up Walmart's revenue streams into US domestic and Sam's brick and mortar, international retail, e-commerce retail, and advertising. We projected the cash flows for each revenue segment and discounted them back using our WACC to get a price target of $63.17, roughly a 13.5% upside. Now looking at a relative valuation, we combined the same peer groups in those four categories. Now, something important to note here was the difficulty in finding good peers for international and advertising. This is due to the fact that Walmart is massive. There's really not a lot of companies out there like Walmart, so it's kind of hard to find peers for this area. With that being said, we found a target price of $66, representing a little over 11.5% upside.
Thank you, Jaden. And as we walk through, we want to talk through some further considerations. Let's begin with risks. International expansion and increased capital costs are the greatest risk to long-term value. Within e-commerce, loss of merchant control is expected to be offset by the synergies gained from capitalizing on existing infrastructure and Walmart's dominant transportation and logistics platform. Internationally, cultural myopia is the biggest risk. This is the idea that you can't take an operating business from one culture, move it to a completely different culture, and expect the same results. We saw this in South Korea, in Brazil, and Germany, where Walmart lost billions. Domestically, theft is the biggest risk. We see a strong rise in retail theft. And within the Colorado area, we've seen restrictions placed on self-checkouts in retail stores in the hopes of preventing retail theft. Macro risks, again, are not a concern. We've seen Walmart continue to grow unabated through recessionary periods. For example, during the Great Recession, Walmart's earnings per share continued to grow. Now I'll pass it off to Jaden to talk through ESG.
So wrapping up with ESG, Walmart has a Sustainalytics rating of 25.3, which represents medium risk in terms of ESG. Now, this isn't bad, given that they're well ahead of Costco and much better position than Amazon, with Target being the outlier of being ahead of the game.
1 minute remaining.
Environmentally, Walmart doesn't greenwash. Spearheaded through Project Gigaton, they have been reducing their carbon emissions immensely. Socially, they're the biggest employer in the world, and paying all of these wages are their primary societal impact, with them increasing hourly wages over the past few years to increase this scope. Lastly, with governance, although a bit concerning that the Walton family still controls 46% of shares, we see a great synergy between management and investors. Recently, we saw an 80% approval rating for the new executive compensation plan by shareholders. Their commitment to say on pay is great.
Thank you, Jaden. And again, we're issuing a buy recommendation for Walmart, target price $66.70, which represents a 13% upside. We came to this valuation using a sum of the parts methodology. And most recently, in Walmart's quarterly report, they noted that e-commerce was up 23% and global advertising was up 33%. We expect these trends to continue. Thank you very much, and we'll take your questions at this time.
Thank you. Judges, at this time, please turn on your video. Please stay muted unless you are speaking. I will start time as soon as a judge speaks the first word. The Q&A period will last at least 10 minutes. If it is still going after 10 minutes, we will continue for up to 15 minutes total. If any time after 10 minutes the judges have no remaining questions, we will end the Q&A period before 15 minutes. Please feel free to begin.
I'll start us off here. So on Walmart Plus, when you think about the growth trajectory of that versus something like Amazon, do you believe that a customer would subscribe to both of those services? And how, when you think about access and saying, if someone says, hey, I'd rather spend the money on Amazon, what is the real value driver that Walmart can establish with Walmart Plus that's maybe different than something like Target or other competitors?
Absolutely. And I think an important piece of context for your question here is the trajectories that both Walmart and Amazon are on. Walmart started as the brick and mortar platform, right? And Amazon started as a pure e-commerce platform. They're targeting the same end product, right? A online platform with physical locations around the country and the world. The important consideration for Walmart over something like Amazon Prime is the fact that Walmart Plus is designed to integrate with the in-store experience over Amazon Prime, which is seen by Whole Foods shoppers as more of an add-on than an enhancement of that experience, right? So what we believe is that Walmart Plus users and subscribers will be enticed to the service because they're already Walmart shoppers. And as Walmart expands store locations, it gains not only more Walmart shoppers overall, but again, those flywheel effects, those shoppers build into the e-commerce platform, which builds into the need for more effective transportation and logistics platforms. Did I answer your question with that, or can I clarify a little more?
No, that's good. And then on advertising, what is the opportunity there? Is that significant when it comes to especially digital advertising?
Yes. Okay. One key point on the digital advertising platform compared to physical advertising is the underlying data and the ability to curate the environment for digital advertising versus the paper signage, right? So, for example, when we were brainstorming through how to talk about this, one example was, say, an advertiser wanted to specifically target, say, single mothers with their products, right? Well, now with digital signage, you can choose the hours of the day, the days of the week that you have those advertisements on the screen, which increases the effectiveness of the advertising and lowers the overall cost for advertising partners.
Going with that too, there's substantial benefits with this. I mean, advertising, it's not being utilized yet. I mean, the old advertising, if Walmart is launching some big program and they're going to do some ad campaign in 100 different stores, they have to physically print off 100 different signs, set up 100 different things, versus this digital advertising. It's so much more customizable. I mean, if some program isn't working right away, changes need to be made, consumer habits shift, something happens where they need to right away update advertising to more suit their position and where they want to be. It's way easier to be done through their new advertising on a digital platform, which once again feeds into that flywheel.
Do you think that's a meaningful cash flow generator, or did you build that into your valuation at all?
Yeah, so advertising was a separate cash flow in our model. And where we see the biggest increase is, Walmart's not going to turn into an advertising agency. We just think that their advertising integrating with the amount of data they already have on their customers and integrating with these new e-commerce, trying to get this omni-channel platform started. We really think that's where advertising will be leveraged to help boost their existing business.
Okay, thanks.
Hi, could you talk about some of the characteristics of ownership of Walmart stock and how that affects the outlook for the stock going forward?
Yeah, so currently, once again, they're controlled 46% by the Walton founding family, which is separated into two different entities. Now, a lot of their high-level investors, a lot of the rest of their company is owned by high-level investors. And yeah, the 46 is concerning. Our only thing that we don't think this is a big of a concern is due to the fact that these are family members, right? They're sitting on a gold mine that's Walmart, something that's going to be consistently paying them every year. So although, yes, it's a bit concerning, we don't see them trying to take too many actions to make massive changes, as they're playing on the side of conservatism, most likely.
Yes, and if I may add, one key point with Walmart and the revenue mix changes that we're forecasting is the fact that an investor in the wholly brick and mortar business, as the digital, call it e-commerce or advertising businesses, take more of the overall revenue mix, that may change individual investors' how they think about Walmart in their portfolio.
Okay, thank you.
Of course.
Can you expand? I understand that you're projecting a significant margin increase. However, I see that it jumps in 2024 by more than 200 basis points. Can you explain in more detail what's driving that and why did it happen so suddenly and so soon?
Absolutely. I mean, just to clarify your question, you're talking the most recent kind of uplift we've seen in Walmart stock, correct?
No, I'm talking about the margins. So if you go to your appendix where you are forecasting the margins.
Oh, yes.
So I see it goes from close to 6% to around 8%.
On the margins on advertising you're talking about, yes?
Yes.
Sorry, I was a little confused there. No, the idea here was that we're seeing just significant utilization, and we forecasted that 24 through 25 would be a kind of build out year for advertising. This is a new idea that is getting implemented in some test stores and is expanding right now. As we see it implemented in more stores and fully built out, we expect a larger jump in those margins and then slow growth over time.
If you're wrong on your buy case, what will be the principal reason?
The principal reason would just be what we believe to be poor execution. If 3 years from now Walmart hasn't been able to integrate its advertising and e-commerce well into its brick and mortar platform, the potential gain is lessened, right? We don't see these as siloed impact within the growth of each business. We see uplift from advertising having an uplift on brick and mortar growth, which has an uplift on e-commerce growth as well. If these grow in silos with little interaction between the two, we wouldn't see as much growth.
Yeah, Walmart, through their advertising and e-commerce, I mean, once again, it brings it back to them building their omni-channel retailing. I mean, their investments in e-commerce actually are a lot of brick and mortar investments, and it's through their transportation and logistics, which if where the model breaks, or if worse comes to worse and investments don't pan out, we see the losses from that being very minimized, especially compared to the gains we see from the potential from it, due to it kind of all being synergized with brick and mortar advertising and e-commerce.
Okay, thank you.
How do you see the threat of Amazon factoring into your valuation, especially since they are the largest in the e-commerce, which is expected to grow significantly?
I'm sorry, I missed the first half of your question there. My apologies.
Oh, it's in regards to Amazon and the threat of Amazon being the largest e-commerce player by far. How do you factor that into your valuation? What type of market share are you expecting Walmart to gain from Amazon or lose from Amazon?
Absolutely, and I think a great point there is, from our perspective, Walmart and Amazon are playing against two different audiences right now. At least in the initial growth of the e-commerce platform. Amazon right now, I believe, I want to say between 40 and 60% are Prime subscribers who visit the site. I'm pulling these numbers from memory, so my apologies. But the Walmart Plus subscribers are only between 20 and 30%. of site visitors and those people who interact with the program. So the potential growth for Walmart right now is to convert more of those single users of Walmart's e-commerce platform into subscribers who integrate this into their shopping experience. And as Michael said earlier, or as we talked about Michael's question earlier, the growth of Walmart's e-commerce platform is synergized with its users and its customer base in the physical stores. And we want that to be clear.
Yeah, going right along with that. I mean, we're not really saying that Walmart's going to come through and steal all of Amazon's customers. It's instead, how do we utilize the customers that we currently have going to these stores more? And one thing that's important to note was during COVID back in 2020, Walmart's CEO came out and said that customers who participate in their omni-channel retailing, so order through the phone, go in, pick up, they generally spend twice as much and shop in-store more often than customers who don't. So it's less of trying to steal from Amazon, and it's more building on what we already have.
I had one last one here, maybe two more. Valuation. What is the, there are, Walmart's one of the most covered companies out there. And so why, if you're a sell-side analyst, why would you have anything other than a buy opinion on the stock?
Well, we'd see some analysts come out with a hold opinion right now. We would see that if they don't believe that the investments in advertising and infrastructure are going to be additive to Walmart's enterprise value. We could see a sell recommendation as well if they were particularly downtrodden on the return that Walmart was going to gain from the capital they're investing in these initiatives. And our counter to that would be that Walmart's investments aren't single silo investments, right? The purchase of a new store, the allocation of capital to a new country is not just growing e-commerce, it's growing their brick and mortar and e-commerce and providing more advertising outlets.
Okay, and on the financial analysis of Walmart, do you see any, are you concerned about their overall financial position from a debt to equity perspective, given the higher rates?
No, I'm sorry, I cut you off there.
I was just saying, given higher interest rates here, debt is not as cheap as it used to be. Does that affect how they think about the future, given how much capital they have to put out just to make a few percent?
I would say, I mean, with any company, yes, it is always a budgeting concern. Do you have the short-term capital to cover what you're saying? The nice thing about Walmart is that they're insanely massive. They have a AA rating. They're easily able to tap into commercial paper and other short-term markets to easily raise capital. I mean, a company like Walmart just going bankrupt within a day isn't really anything I don't think anybody can see on the horizon. So just due to the fact that their size really allows them to tap into these short-term markets, we don't see any concern with short-term liquidity.
And if I may there, beyond the liquidity issue, you are right, Michael, the cost of capital, the required return on investment that these investments have to generate is a lot larger now than it was 4 years ago. However, what we're seeing is the synergy between the investments, right? This isn't an investment in a distribution center like Walmart is doing. This is investment in multiple nodes in a transportation platform that both enable more effective e-commerce service and provide a stronger reach of their brick and mortar service to customers.
Okay.
One last question. If you go to slide 23.
Of course.
Yeah.
Yes, sir.
Here we also see a significant jump in margin, going back to that point. The EBITDA margin from 5.6, when historically they've never hit even 7%, but then going forward, you are projecting above 8% every year. So this is a combination, I understand, of all businesses, but can you walk us through why that's so sudden, that significant jump in the EBITDA margin?
Yes, absolutely. we're seeing kind of the core of why we did a sum of the parts analysis and the core of our valuation is that we are forecasting a shift in their revenue mix overall with a larger growth in higher margin businesses that will now take up a larger portion of Walmart's revenue and yes, EBITDA overall. So this, as we add in more higher margin businesses, and the margins on advertising and e-commerce are significantly larger than the sub 10% margins in brick and mortar locations.
Time. Thank you, University of Denver. At this time, the judges will take a few moments to collect their thoughts and make notes before the next university is brought in.
Yeah, thank you all so much. Have a good one.
Thank you.
Please launch your presentation and make sure it is working properly.
Sounds good. Can you hear us?
Yes.
Perfect.
Everything appear right on the screen?
Yes. Please stay muted unless you are speaking. I will start time as soon as a member of your team speaks their first word. You will receive a 1-minute warning and time will end precisely at 10 minutes. Please feel free to begin.
Good afternoon, everyone. My name is Damien, and I'm joined here with my teammates Luke, Tyler, Jack, and Riley, and together we proudly represent the University of Minnesota Duluth. And now, come with us on this bumpy ride as we narrate our investment thesis on Polaris. We are issuing a sell recommendation on Polaris with a 12-month price target of $86, implying 13% downside. So why is this? Well, we conducted a rigorous proprietary research survey of over 250 channel checks to Polaris dealers across the United States, which led us to these 3 catalysts: consumer demand slowdown, supply chain mismanagement, and structural disadvantage when compared to competitors. Headquartered in Medina, Minnesota, Polaris designs, engineers, and manufactures powersports vehicles through 3 main segments: off-road, primarily selling ATVs, side-by-sides, and snowmobiles; on-road, with the sales of motorcycles and 3-wheel roadsters; and lastly, marine, selling premium pontoon and deck boats. And now Jack will discuss ESG.
Thank you, Damien. For the industry that Polaris operates in, they are an ESG-friendly company. We gave them a score of 82 out of 100, resulting in a total ESG grade of a B-. For their 2022 goals, Polaris aimed for and achieved significant environmental milestones, surpassing targets in greenhouse gas reduction, an improvement in their energy efficiency, and the expansion of their renewable energy portfolio. Looking ahead, Polaris is on track to meet ambitious environmental goals by 2035, laying out a roadmap for a greener future. Polaris implemented a post-sale surveillance program that utilizes technology to detect safety and quality signals. This policy defines how they'll investigate to ensure safety for their riders. Polaris's Ride Together approach encourages all employees to make a commitment to respect, inclusion, diversity, and equity. Polaris has a tenured management team with their board lacking in diversity affecting their ESG score. Both CEO Mike Speetzen and CFO Bob Mack are largely compensated based on performance, though it's important to note that a large portion of this is in the form of cash. Now I'll hand it over to Riley for an industry overview.
Thanks, Jack. The powersports industry relies heavily on product innovation to attract new customers. With numerous manufacturers competing on price and quality, brand recognition and reputation are crucial to sustain growth. Increased competition within the industry has led to many competitors engaging in acquisitions to further boost top-line growth. Polaris has established their business as a premium brand within the powersports industry, primarily competing with BRP in off-road, Harley-Davidson in on-road, and Manitou in marine. We believe Polaris will remain a premium brand, but will face increased pressure from growing competitors. I'll now pass it to Tyler to explain our investment thesis.
Thank you, Riley. We will now elaborate as to why the company's downside is not fully reflected into the stock price. Our investment thesis relies heavily on a comprehensive proprietary survey in which we conducted over 250 channel checks to Polaris dealers across the United States. Of the 250 checks, we got 100 concrete data points in which we used in our estimates. These estimates were then reinforced by a follow-up survey to select dealerships following their first quarter earnings. We found that 49% of dealers anticipate a sales decrease in calendar year 2024, 36% expect flat sales, and a mere 15% are optimistic about sales. Based on our findings from our proprietary survey, we have identified 3 key catalysts: consumer demand slowdown, supply chain mismanagement, and structural disadvantage when compared to competitors. Starting with demand slowdown, based on our survey, we anticipate sales dropping throughout 2024 and won't fully recover until 2026. Well, why is this? The current combination of the Fed funds rate paired with the lowest personal savings rate since the Great Recession is squeezing consumers. Our channel calls indicated a significant decline in dealership foot traffic. And furthermore, dealers noted the impact of elevated interest rates will persist all throughout 2024 and well into 2025. When using history as our guide, the last time the Fed funds rate was over 5%, Polaris significantly underperformed. Due to the high sensitivity of discretionary spending and minimal demand, margins suffered disproportionately. As of their latest earnings call, management lowered 2024 sales guidance to down 7% and EPS guidance to down 15% versus 2023. This is more in line with our proprietary findings as we are modeling sales down 11% for the year. I'll now give it over to Luke to talk about our second catalyst.
Thank you, Tyler. Issues with part sourcing and dealership inventory management have plagued Polaris since the start of the COVID-19 pandemic. Leadership has downplayed the persistence of these issues in recent quarters as unexpected expenses continue to pile up. Through our proprietary survey, we found that a majority of dealerships reported that inventory buildup has reached levels not seen since 2019, levels that Polaris pledged they would never meet again. Polaris manufactures 100% of their vehicles in North America. However, 2/3 of their supply chain operates internationally. This structure caused production difficulties highlighted during the pandemic, leading to major capital investments into factory revamps and additional import tariffs of $100 million per year. Now Riley will discuss Polaris's competitive disadvantage.
Thanks, Luke. Polaris has historically had a strong moat driving innovation within the powersports industry. BRP, Polaris's biggest competitor, disrupted this moat with the launch of the Can-Am Defender in 2015. To further compete with BRP and expand into adjacent markets, Polaris acquired Trans-American Auto Parts in 2016. This acquisition failed, however, and was recently exited at a $600 million loss. So what's been the significance of these changes? Well, BRP has considerably outperformed Polaris on sales, management effectiveness ratios, and margins over the past decade. As Polaris continues to focus on improving profitability, we favor BRP's operational efficiency and execution driving sales growth. Now I'll pass it to Damien to walk you through our financial analysis.
Thank you, Riley. Polaris has a 10-year revenue CAGR of 8.5%. However, due to our proprietary research and our 3 catalysts, we project sales to be down 11.2% in 2024 and to grow 7.7% in 2025 as discretionary spending rebounds. Gross margins have been in a steady decline since 2014, and we are convicted margins will continue to fall in 2024 as they face continued pressures due to high fixed costs and their sales decline. Going into 2025, we expect a slight margin rebound as CapEx shrinks and the demand starts to recover. Here are gross margins from the latest earnings report, and as expected, across the board, they have been heavily pressured, falling over 300 basis points in each segment over the last year, which is largely due to significant promotional discounts at the dealership level. Margin compression during a time when goals were set to expand profitability, further showing the lack of transparency and execution of Polaris's management. And now for Jack to discuss liquidity and returns.
Thank you, Damien. For Polaris, short-term liquidity concerns are highlighted by a consistent decline in inventory turnover, with our channel checks confirming slow inventory movement for the next year. As a result of debt taken on by acquisitions, Polaris is now constrained by higher interest rate payments, limiting their profitability potential. When examining the return analysis on Polaris, we can see the long-term depreciation and management effectiveness ratios, specifically when BRP released their utility vehicles, when Polaris conducted leadership changes, and when the 301 tariffs were enforced. Now I'll hand over to Luke for our evaluation.
Thank you, Jack. The results of our proprietary survey indicated that dealerships on average anticipate sales declines of 10%, 15%, and 16% this year across the off-road, on-road, and marine segments respectively, not recovering until 2025. To stimulate demand, Polaris has instituted several promotional discounts on products, which we anticipate will pressure margins further. Incorporating lower sales and profitability expectations for next year, paired with increasing inventory as the channel fills, we derived a free cash flow estimate of $123 million for 2024. When conducting our intrinsic valuation, we incorporated the sales and margins estimates derived from our proprietary survey before determining our terminal value and discounting all future free cash flows at a WACC of 8.5%. After subtracting net debt, we arrived at an approximate price target of $86 per share. In addition to our intrinsic valuation, we conducted 12-month relative multiple valuations, again arriving at a price target of $86 per share. We believe that the financial outlook for Polaris is significantly worse than it has been over the past half decade. Therefore, our assigned multiples reflect contractions from both Polaris's historical levels and that of their competitors. Displayed here are the results of 2 Monte Carlo simulations based on our DCF price target using 2024 revenue growth and gross margin estimates. The red portion of the graphs represent price targets with greater than 10% downside from current prices, while the green represent outcomes yielding 10% upside or more. And now I'll be addressing the risks associated with our investment recommendation, the first of which would be the execution of an economic soft landing by the Federal Reserve. Second, the stabilization of the supply chain on both the product sourcing and dealership level. Third, the successful integration of outside suppliers into Polaris's network. And fourth, Polaris delivering value to shareholders in an optimal balance between dividends, share repurchases, and capital investment. Finally, I'll pass it on to Tyler for our conclusion.
Thank you, Luke. We want to reiterate our sell recommendation on Polaris with a 12-month price target of $86, reflecting potential downside of 13%. Again, this is based on our 3 key catalysts: consumer demand slowdown, supply chain mismanagement, and structural disadvantage when compared to competitors. Thank you, and we'd love to open it up for any questions.
Thank you. Judges, at this time, please turn on your video. Please stay muted unless you are speaking. I will start time as soon as a judge speaks the first word. The Q&A period will last at least 10 minutes. If it is still going after 10 minutes, we will continue for up to 15 minutes total. If any time after 10 minutes the judges have no remaining questions, we will end the Q&A period before 15 minutes. Please feel free to begin.
I had one or several actually, but I'll start with you talk about supply chain where they're reliant on, areas outside of the US. So how do you see them going forward? Like, what would you recommend they should do where should they resource, and what would that cost them to do if they resourced in the US, for example, or Mexico? What would that do to margins?
Right, I can take that question here. So what we would like to see strategically, at least as far as supply chain is concerned, would be reshoring a lot of their suppliers, vertically integrating specifically. And they've taken steps to do this in the past year, specifically with their acquisition of Walker Evans Racing, which is one of their main suppliers. But as far as cost goes with that, obviously acquisitions are an incredibly expensive use of capital. There's a lot of risk involved with synergies. So it would be a rather cost-intensive endeavor, but we think that's the best operation for them. The supply chain was, the vulnerabilities were really exposed during the pandemic, which hindered their output. So being able to reshore a lot of their suppliers could help with that. And then as far as the Mexican manufacturing impact would go, we see that as a major benefit, both from a cost of labor perspective and from an import perspective, as there's lower tariffs as far as transporting from their offshore suppliers into Mexico. And we expect the impact that would have on margins to be quite substantial if they're able to move towards manufacturing in Mexico. That's a move they've taken already, and some of their competitors have jumped in on as well.
But you're suggesting that if they move to Mexico, it would actually be more, their margins would improve.
Yeah, I think on a gross margin level specifically, just that's where they factor in a lot of their tariff expenditures, which is a competitive dynamic we've observed with BRP specifically. They haven't been nearly as exposed to that, both by manufacturing in Canada and in Mexico. They've been able to avoid a lot of those import tariffs. So we think in the long term, and even perhaps in the short term, it could be accretive to their margins.
And what about, let's go ahead.
Sorry, and to add to that, it would save them that $100 million a year from the tariffs, but then it would also allow them to still tell their customers that these products are manufactured in America still, along the lines in Mexico, while saving money on all these input costs and labor costs.
So I know this from I know people who have some of their equipment, and I know they're sort of on the ground, sometimes not thought of as having as high a quality as something like Honda or Kawasaki or Yamaha even. So do you think they would be able to improve quality of their product by changing this their manufacturing footprint?
Yeah, I could touch on that question. I guess kind of like from what our checks have indicated is like we've seen Polaris, I guess the dealerships we've talked to view Polaris more as like the premium brand leader, along with BRP. When we went with management on like our analyst day, one of the things that they were talking about is a lot of the Japanese manufacturers like Honda, Kawasaki, Yamaha, et cetera, have been kind of like decreasing in market share. And that Polaris and BRP have been overtaking some of their market share positions, just due to like it's a large part of their business and they're focusing on it, and the Japanese OEMs like aren't focusing on it as much. So I guess like from our calls, I mean, they've indicated that Polaris does have like a stronger product. We have seen customers switching from Polaris to BRP products with some of the recent product recalls that Polaris has had.
Yeah, one thing to add on to that is Polaris is known as the innovator within the power sports industry. So all of their new models are incorporating, you know, new features, new types of engines that haven't yet been seen. So the problem with that is, although it's great to be innovative, the problem with that is they have a significant amount of recalls, which has further eroded consumer confidence with the company.
Okay, and then second one here. So you have a sell rating, and it seems like a lot of that could be based on the work that you performed on your survey. So while if we do have consumer weakness and they do see sales decline and potentially even margins, because I would imagine there's some sort of scale to their business, would the market see, why would the market price that in already? Why would we not be closer to your price target if the market does actually go down and there is actually weakness? Do you see more, is your sell thesis more of a valuation call versus like a structural fundamental bear case?
Yeah, I can touch on that. So due to our survey, we actually contacted 250 different dealerships, and that led us to our sales growth decline of 11.2%, where management this past quarter has only indicated to the street that they'd be down 7 to 5%. So we have reason to believe that they are going to reduce guidance again in their revisions coming in the next couple of quarters, which will impact their stock price.
Do you know if your surveys are sort of in line with some of the other vendors out there who do similar things?
Can you elaborate on that?
So, Gartner or some, a third party type vendor who would do similar surveys. Wouldn't be Gartner, but there's companies out there that do these types of things. Have you compared the results of your survey to another vendor?
Well, we don't have access to that research.
Sure. Okay.
To any of the information.
Yeah, it's very expensive, so I understand if you didn't. I just didn't know if you somehow did have that access.
Mm-hmm.
To follow up on that question on the proprietary research, were you able to quantify the extent to which channel stuffing has occurred? And how did you manage to translate the information you gathered to an actual number in the pipeline?
Yeah, I think I can take that one. And Damien, if you want to go to the valuation slide 11, as far as the valuation goes, perfect. Okay, so again, like we mentioned, our valuation really starts with our sales estimates. That was the easiest term to figure from our data points. We took a median estimate of basically the results by segment. We were guided by dealerships. And then as far as like the channel goes, as far as the channel goes, it was a bit more difficult to quantify just because dealerships weren't as either eager to share or in the know of the exact change in their dealership volume over the past year. So as far as like our change in net working capital with the current assets goes, we went off of more what management has been able to report in some of their recent earnings about dealership inventory levels. And in our presentation, we saw snowmobile inventory year over year has been up over 100%. So we factored more of that into our inventory levels, just because we see if the dealerships are backed up in inventory, that means Polaris's inventory on their balance sheet is going to begin to back up as they can't create that flow with the dealership. So that's where we got that elevated change in net working capital from. Because just to clarify on the inventory recognition practices for Polaris, when they sell their units to the dealership, that's when they recognize revenue. So we've seen the buildup on the dealership inventory level of their inventory. That's not what's reflected on Polaris's balance sheet, but we just think with the jam on the dealership level, the inventory has begun to accumulate on their balance sheet. So that's really where we got that estimate from.
Thank you.
Yeah.
And then as far as how we quantified it, we talked to owners, we talked to managers, we talked to sales associates with long tenures, and based on how experienced they were in their field and how long they've been in this environment, we've sort of weighted when we ask these questions of how have your sales been in the last 12 months and how do you expect them to be the next 12 months? We sort of weighted them based on their experience in this industry, as well as the inventory positioning.
Kind of a follow-up question to that one, since a big chunk of your evaluation is based on the survey. What kind of assessment or evaluation you did to ensure that your sample was representative of the population?
Yeah, so I can touch on that one as well. We reached out to 250 of around 600 dealers in the US, and that is where a large portion of their revenue is arrived from. And based on a statistical sample, as long as it's above 30, it accurately represents the population. And so that's why we went above and beyond up to the 250 mark with 100 concrete points to guarantee that we represented the entire population. Because all of our calls were throughout the US, they weren't specifically in just like one region.
And did you ensure, for example, geographical representation as well as across all of their product lines?
Yep, I can take that.
Okay.
So if you want to go to the map. Yep. So these are the locations that we actually spoke with. So main concentration is specifically in Minnesota, in Colorado, and then in the Southwest region of the United States. And we would call dealers that not only sold different segments of Polaris's business, meaning off-road vehicles and on-road vehicles. We also spoke directly with specifically Indian motorcycle dealers or specifically the marine segment pontoon dealers. So we got a weighted average of all three segments within our estimates. And then if you want, Damien, if you want to go to the estimates by segment slide.
I believe it's segment revenue projections right under financial analysis 6.
Yep, there we go. So from us speaking with the dealers, we were able to project sales estimates for each of the main segments. So for 2024, we're projecting the off-road segment to be down 10%, on-road to be down 15%, and marine to be down 16%.
Right. And just to further expand on the accuracy that we feel our survey has, when we mentioned our follow-up calls, in that subsect, we targeted roughly the top 15 to 20% in terms of volume of inventory sold in terms of Polaris products. So in our follow-up, we essentially asked these places we'd already made contact with sort of what the current conditions were like. And as you can see, a lot of our thesis ended up being reinforced. This was done in the latter part of Q1. So speaking with these same dealerships, we essentially reinforced what we heard in Q4. A lot of the same story, inventory levels remaining sky high, major backup on both old products from last year and the newer products. They're seeing lower demand moving forward as far as pre-orders go. Again, the discounts have even more significantly ramped up in Q1. We're seeing lower discounts on their newer models and even the models from last year as well. And like we've mentioned, the product recalls, we've seen sort of a shift, at least to some extent, to BRP products as far as the recalls concerning Polaris goes.
Very good.
I had one on valuation. Can you walk us through that? What did you project on sort of like a terminal growth rate?
Right. Yeah, I can take that if you want to. Yep, this slider here. So as far as the terminal growth rate went, we assumed around a 2.5% growth rate, simply because factoring in the average rate of inflation expectations targets around 2.5%. And then looking at the industry of the power sports as a whole, volume from a TAM perspective hasn't really grown over the past decade. So we don't see necessarily major opportunity as the industry grows in terms of volume, but rather as prices increase. So that's where we came to around the 2.5% for the long-term growth. And just as far as like the DCF goes, like I'd mentioned with the current assets, seeing inventory build up, that's going to affect our change in net working capital. Capital expenditures, internal investment has been the top capital allocation priority of management. They've guided these figures when we spoke with them specifically in their analyst day in between Q3 and Q4. So that's where we got those figures from. And I could get into our WACC calculation too if you want. They're roughly.
That's okay.
Perfect.
Yeah, I mean, I would love to, we still have enough time here. In terms of basically the weakness you're projecting here in the next year or two, how much of that is affecting your valuation overall versus kind of a 3% long-term growth rate?
So
if they didn't decline as much as you think they will, what would your target be?
Time. Thank you, University of Minnesota Duluth. At this time, the judges will take a few moments to collect their thoughts and make notes before the next university is brought in.
Thank you, judges.
Thank you all.
Yeah, thank you.
Thank you.
Welcome, University of Waterloo. At this time, please launch your presentation and make sure it is working properly.
Is it sharing?
Yes. Please remain muted unless you are speaking. I will start time as soon as a member of your team speaks their first word. You will receive a 1-minute warning and time will end precisely at 10 minutes. Please feel free to begin.
Amidst one of the most severe freight recessions in recent memory, Cargojet represents a highly resilient freight leader with attractive upside. We would like to issue a buy recommendation for Cargojet based on a 12-month target price of $140, implying a 24% upside. This recommendation is predicated on our 3 thesis points. First, that Cargojet is an exceptionally well-positioned business, creating a strong margin of safety. Second, that through its high operating leverage and stronger than expected growth opportunities, the business will realize significant margin expansion. And third, that Cargojet is at a critical inflection point in its ability to generate returns. Now, positioning Cargojet in the freight value chain, they operate in the middle mile and move things from city A to city B on a plane. And this is critical to the operations of their customers and upholding their value proposition, given the wide nature of Canada's geography. They are Canada's only scaled national dedicated air freight carrier and carry a variety of time-sensitive cargo, including e-commerce goods, food and beverages, and pharmaceuticals. Transportation customers we interviewed outline that they care most about 3 things, and across these factors, air freight is the only viable option for moving time-sensitive goods. And within air freight, you have passenger belly cargo, dedicated freighters, and customers consistently echoed that dedicated freighters are the only viable option for moving time-sensitive cargo due to their expedited nature, reliability, and capability of moving large volumes of cargo. And Cargojet represents 90% of this market in Canada.
Cargojet's revenue comes from 4 main sources. There are core segments, and the fourth is a pass-through vehicle with no cash flow impact. The domestic business services over 90% of Canadian dedicated freight for leading transportation and logistics customers like Amazon, FedEx, and UPS, who reserve space on a Cargojet-controlled flight to one of 16 hubs across Canada. This segment is characterized by extremely high-quality revenue contracts with high minimum volume and revenue guarantees, full fuel cost pass-through, and annual price step-ups. Cargojet provides aircraft, crew, maintenance, and insurance in their ACMI segment to DHL, who makes up 95% of the segment. And this is to service their European, Latin American, and Southeast Asian flights. DHL pays for all the costs to operate the flight and then pays Cargojet a rate on top of that. Cargojet also provides charters on an ad hoc basis for customers on a cost plus spot rate basis. And though Cargojet was able to capitalize on growth exceptionally well throughout COVID, it has recently been impacted by the ongoing freight recession.
Now, to get deeper into the freight recession, supply declined dramatically during COVID as belly cargo freight dropped due to a lack of passenger flights, driving air freight rates and yields both down. This led to significant industry-wide investment aiming to capture the strong demand in dedicated freighters. More recently, that demand has cooled off and that overinvestment has led to supply imbalances, driving rates down and all culminating into a very severe freight recession. Stepping back to see the impact on Cargojet, we know that COVID drove the share price up, and later the market began to punish the business due to fears over the freight recession and their ability to generate returns. However, management is now committed to a strategy shift focused on returning capital to shareholders through share buybacks and dividend growth. The market is beginning to reward this decision, reflecting our own thesis that Cargojet is an extremely high-quality business with strong margin expansion potential at a critical inflection point.
Our first thesis is that Cargojet is exceptionally well-positioned in its operating environment. To form a view on the business, our team interviewed 14 industry experts, including advisors, former executives, and leaders in competitors and customers. As a result of this primary research and our own analysis, we came to the conclusion that Cargojet is, at its core, exceptionally well-positioned. The three pillars of their defensiveness are the fact that first, they have no real competitors domestically, and that regulation blocks international players from flying point to point within Canada. Second, that the company has strong alignment with world-class customers internationally. And finally, that the company represents a critical, almost irreplaceable service. First, Cargojet has virtually no competition in Canada, as they compete in a fundamentally different cargo model than passenger airlines, competing for different types of freight. Though some passenger airlines have attempted to build a dedicated freight business, experts we interviewed, including freight leaders at Air Canada, echoed our analysis that it's nearly impossible to build and scale an overnight business without key anchor customers, all of whom Cargojet has locked down. This alignment with key customers is twofold. Firstly, through warrants issued to customers, which give Cargojet strong certainty of revenue and lower their risk of replacement. Secondly, through the fact that customers are making material facility investments near some of Cargojet's biggest hubs, further increasing their stickiness. Experts we interviewed don't believe that there's any reason for these relationships to deteriorate. And finally, our team built a model to better understand the volume requirements a single customer would need to have in order to break even on replacing Cargojet. And what we found was that unless an individual customer can move upwards of 25% of the total national domestic freight volume carried in Canada, replacing Cargojet simply doesn't make financial sense.
Building on from Cargojet's strong competitive positioning, we believe they have stronger than expected growth opportunities that should drive margin expansion given their high operating leverage. Starting off, we believe the market is underestimating Cargojet's growth potential in their primary segments. First, domestically, Amazon believes Canada is one of its most important markets due to the strong population growth and low e-commerce penetration. They continue to invest heavily into Canada while canceling and closing investments in other countries. Our primary survey shows that Canadian consumers value online shopping more compared to pre-pandemic, indicating a secular shift in e-commerce behavior, driving that increased penetration and volume growth for the business. Additionally, through their ACMI agreement with DHL, Cargojet has access to Latin America and Southeast Asia, which are two emerging markets that are extremely fast-growing and have demonstrated resiliency against the freight recession. Cargojet is a really important partner to DHL, and after analyzing their flight activity over the past 3 years, we know that they're helping them aggressively expand into these newer areas. In turn, DHL has also partnered with leading e-commerce marketplaces and has made significant investments into these regions, which should drive volumes for the business as well. Keeping all of this in mind, 85% of Cargojet's direct costs are fixed, and these costs only experience increases when there are fleet and facility expansions. We do not believe this is likely given their current CapEx plan, and combining their growth opportunities With their high operating leverage, we believe this provides a perfect runway for the business to see margin expansion.
Cargojet is now at an inflection point where increased volumes can be sustained without substantially growing their fleet, driving margin expansion and strong returns, and management can return excess cash flows to shareholders. Cargojet has consistently outspent other dedicated freight peers in order to consolidate the Canadian market and to capitalize on growth in e-commerce. This has historically come at the cost of their ROIC, leading to investor concerns in the past. However, they're now amidst a strategy shift that puts a pause on their growth capex plan after 2025. And we have conviction that this plan can be successfully executed after analyzing their capacity and utilization, which currently sits at about 80%. This strategy keeps costs stable, and as margins grow, Cargojet will drive about 8 points of ROIC improvement, which can be equally attributable to the improvement of their NOPAT and to the completion of their capex plan. In addition to this, their improving credit profile allows them to stay flexible in purchasing more aircraft if growth is stronger than expected. This strategy also focuses on shareholder returns, with Cargojet announcing an NCIB in early November to buy back roughly 9% of their shares and increase their quarterly dividend by 10%. And so over the next few years, management will place a greater emphasis on returning capital to shareholders.
Cargojet's management team strongly influences the realization of our theses. We have conviction in management as they have a strong track record of meeting and beating targets and generating returns. Majority of management compensation is through variable compensation tied to EBITDA, ROIC, and total shareholder returns, which strongly aligns them with shareholders and should drive performance. From an environmental perspective, Cargojet is in line with dedicated freighters and only lags integrators due to its more carbon-intensive nature. We analyze Cargojet's multi-pronged ESG initiatives to create a proprietary ESG scorecard, which reveals that Cargojet does not lag peers in any categories, and this does not highlight any concerns for the business.
So we valued the business using both intrinsic and relative valuation methods. On a relative basis, we've weighted comps at 20% to inform a market view on valuation, but recognize that Cargojet operates a highly unique model with an unmatched competitive moat. This has allowed them to historically trade at a strong premium against peers who consist of other transportation and logistics companies. And we believe this will continue to be the case going forward, and that they should trade closer to their long-term average of 11 times EV to EBITDA. We chose to value Cargojet on an EBITDA basis due to investors focused on EBITDA, as well as it being a capital structure neutral proxy of cash flows, rather than their earnings, which are very volatile due to complex accounting items like warrant amortization. Intrinsically, we built a conservative base case with modest top-line growth where volumes grow.
1 minute remaining.
Price grows at 2%, leading to a total CAGR of around 7%, which, given their high operating leverage, will lead to margin expansion of around 400 basis points. Across both our exit multiple and terminal growth method, assuming warrants are exercised and a relative valuation, the stock yields a blended upside of around 24%, indicating a strong risk-return profile for the business.
Despite our confidence in the recommendation, we have identified a few risks. The largest risk among these was customer concentration, with 80% of Cargojet's revenues coming from its top 10 customers. We believe this is mitigated by long-term revenue contracts, a lack of alternatives, the high cost of insourcing, and the fact that the company has never lost a major customer. The second risk is concerns about their ability to generate better returns in a higher cost of capital environment, but the company has already deployed significant capital and resiliently weathered a freight recession. And so we believe they'll begin to see the benefits of this investment as volumes strongly rebound. And so with that, we'd like to reiterate our buy recommendation. Thank you very much for your time, and we'll open up the floor to any questions.
Thank you. Judges, at this time, please turn on your video. Please stay muted unless you are speaking. I will start time as soon as a judge speaks their first word. The Q&A period will be at least 10 minutes. If it is still going after 10 minutes, we will continue for up to 15 minutes.
Is that
total.
about you?
No, you're good.
Okay.
If any time after 10 minutes, the judges have no remaining questions, we will end the Q&A period before 15 minutes. Please feel free to begin.
Hi, could you please discuss the stock's correlation with rising or falling energy costs?
Yep, so the stock has no correlation with the rising and falling of energy costs because they have full fuel cost pass-through, and there is no impact to their earnings or cash flows based on this.
That's not quite true. Stock does have an effect. The price of the ticket doesn't have an effect. I'm sorry, I shouldn't be talking to these kids.
So does the stock react to changes in energy prices?
No, so like I said, their stock has they have full fuel cost pass through in all of their contracts, and their rates are not based on spot rates. They're rates that they're locked in, they're CPI based price step ups, and so there's no volatility with movement in energy prices.
Thank you.
A question on just I guess, ultimately the demand for their services. So you mentioned in Canada, the regulation sort of keeps competition pretty low. So can you talk through that a little bit? Help me understand that dynamic.
Yeah, absolutely. So if we could just flip the cabotage laws, please. So these are laws unique to Canada, and they essentially stop international players from flying point to point within Canada. And so any international player is not able to land at one location in Canada and then take off and land at another location in Canada. And so this makes it very challenging for anyone to compete in that domestic overnight business in which Cargojet is so dominant.
And is there any risk from a policy perspective of that changing?
We don't think so. These cabotage laws have been around for quite a while, and there's not necessarily any reason for that to change in order to invite more competition into the Canadian landscape. We think it's in the best interest of the Canadian government to continue to prioritize Canadian businesses.
And how would their services compare to, I know transit by rail, there's obviously a different time component to that, but is there a natural cap on the rates they can charge because of other types of transportation?
Yeah, so if we could flip to population density, please. So, the unique thing about Canada's geography is that it's extremely sparse. And so, we've got about 40 million people spread off over a vast piece of land. And so, all the major urban centers are very far apart. So there's kind of two issues with using rail as an alternative. The first is the distance. It takes a very long time to get goods from one point in Canada to another point in Canada. And so, domestic overnight and planes and cargo becomes very, very essential. And that kind of leads me into the second point, which is that customers are not doing this kind of a business simply because they're choosing to. They're doing it because they have to. And so, the demand itself is very inelastic because there's really no other alternatives. And customers don't view rail as a viable alternative, and we don't either.
Got it.
Based on your football field, we saw that you have your target price significantly above the 52-week high for the company. So what are the catalysts that the market would need to see to realize that this is so undervalued based on your estimates?
Yeah, we actually took a look at share price catalysts. So if you flip to share price catalysts, we actually decide to consider what the catalyst would be. And so the first being that e-commerce growth stays resilient through an economic downturn. And so what investors are really concerned about right now is the pause in their growth capex plan and their ability to manage increased in volumes. And so once they see that Cargojet can add incremental volumes onto their current fleet without adding more planes, investors will begin to reward this. In addition to this, when they see their improving ROIC, which they recently began disclosing into their financials, that'll be another metric that investors are really looking at. And so the final attribute that sort of pushes the share price is shareholder-friendly buybacks and dividend growth.
Do you mind to go over sort of their debt profile and how the higher rate environment may affect things like valuation and their ability to sort of manage their profit?
Yep. So if you go and just look at their debt, about 50% of their debt is hybrid debt. That's at a fixed rate, and this essentially gives them the opportunity to pay either through cash when they're mature or issue stock to do that. And so they're at fixed rate, so there's no impact to valuation as interest rates rise and fall.
Okay. And how much, if there's an equity component, is there a dilution risk here?
Yes, but we believe they have enough liquidity through their line of credit to pay down their hybrid debt, and they have paid their hybrid debt down in the past using cash, and so we don't believe they'll have to issue shares to do this.
Okay.
If we're discussing this stock case, and 2 years from now, and you're wrong on the stock, why will you be wrong?
What we're forecasting right now is that in the back half of 2024, there are interest cuts, and so consumer spending picks up, and so does e-commerce demand. And so what we saw in our bear case was that the only sort of situation that would yield a downside is if the freight recession is extended and there's a prolonged challenged consumer spending and e-commerce growth. And so their revenue profile still stays strong because 75% of their revenues are contracted. It's that remaining 25% that gets challenged. And so we would be wrong if rates stay higher for longer, which is starting to look like more and more of a real risk because inflation is staying stickier, initial job employment is still staying strong. And so that's a big risk for the business in terms of where we might see in 24 and 25.
Okay, thank you.
Any concerns with your assumption that Amazon will grow significantly in Canada? And how would that affect your valuation if those growth plans are not materialized?
So for the first part about the Canadian market itself, it's expected to grow at about 8% per year. And this is on the back of the fact that many international retailers are very, very interested in the country and the widespread untapped customer demographic that exists because of the low e-commerce penetration. And this is also true because even if a bear case does happen or there are any pauses in interest rates for a longer period of time, the total percentage of e-commerce sales within retail sales is very, very high. And this also was verified by the fact that the Canadian population is growing at about double the rate of other G7 countries. So all of these positive tailwinds indicate that the Amazon's growth is very, very significantly great for the company's future prospects.
And if we touch on valuation, if you go to our case scenarios, we've forecasted the domestic business to grow at around 6%, which is a conservative view on the 8% that the market's expected to grow at.
I had just one on the low penetration rate of e-commerce. What is your thoughts on why is that the case versus other countries?
The primary reason for this is the fact that, as Arnav mentioned earlier, the Canadian geography is very, very vast in size, and that's presented infrastructure difficulties just to meet that widespread demand. And because of that, Canadian retailers have notably lagged compared to some other global peers in setting up these sites. And because we're now seeing that change, we think that as the market is projected to grow continuously, Cargojet will be able to take up a large part of that share.
Okay. Didn't have any further questions. Thanks.
Okay, if there are no further questions, we can conclude the Q&A period. Thank you, University of Waterloo. All 6 teams have now presented. At this time, the judges will begin deliberating. Please make sure to rejoin the Zoom session in about 20 minutes to hear which teams are advancing to the global final.
Great, thank you very much.
Thanks. Good job.
Thank you.
Thank you.
Good job.
And welcome back and congratulations on completing this final round of the regional competition. I'd like to start by thanking our panel of expert judges, Michael Casey, CFA, Maura Murihi, CFA, and Edison E. Sepulveda, CFA. Thanks so much for the work that you've done. And we've all seen some remarkable presentations today. The level of thought, attention to detail, insightful analysis, teamwork, presentation skills, I could go on. You have impressed us more than we can say. Use this experience, put it on your CV, highlight it in job interviews, be ready to talk about what you learned, what went well, the things you would do differently. Thoughtful reflection is the surest way to impress an interviewer. So use the experience. Every team today has already enjoyed significant success in this competition, but sadly, only 2 can proceed to the CFA Institute Research Challenge, the global final. So no more waiting. The judges have scored all teams and the results are in. The 2 teams that will be representing the Americas region at the global final in Warsaw, Poland, on the 16th of May are FGV Sao Paulo and the University of Waterloo. Congratulations. Thank you to all the teams, academic advisors, CFA societies, and judges for your hard work and dedication. Thank you also to our global data service provider, London Stock Exchange Group. Congratulations again to the 2 teams advancing to the global final. Samantha will be in contact with advancing teams by early next week. And a sincere well done to all concerned.